closer to 4 as a consequence, at least for a year or two, the Fed's going to find themselves with trend inflation, way above their target. And there's no easy solution for those sectors here. What they really need is technology, innovation, adoption, and delivery of services, right? We're starting to see it in healthcare a little bit, but the healthcare sector is a great one. It's the biggest contributor to SP 500 revenues, but not near that in earnings. Margins have been falling for 30 years.
Barry, we've got to run, but we'll have you back soon because I want to take the next leg of that. If this is your concern on all these things, what do you do as an investor? But we'll have you back very soon to do just that.
All right. Thanks, Ben.
Thank you.
All right, before we head to break, deal news just out. Pfizer is going to acquire Arena Pharmaceuticals for $100 a share in cash. That's $6.7 billion and a roughly 100% premium to Arena's closing price on Friday. Coming up, cyber threat. Tech giants are scrambling after experts warned of a major vulnerability in some widely used software. Details next. And we're watching shares of Apple today. JP Morgan just raised its price target to a street high of $210 a share. The company's market cap would be well above $3 trillion if it were to hit there, even if it hits 182.86. That's the number. We'll be right back. The Department of Homeland Security is urging government and private sector organizations to address what's being called a critical flaw in widely used software. The vulnerability is in a Java-based software known as Log4j that organizations use to configure their applications that could give hackers sweeping access to networks. Researchers say that hackers started exploiting the flaw Friday to gain access to servers running Microsoft's Minecraft game. Amazon, Twitter, Cisco, all companies that have said they were carrying out investigations into the depth of the actual problem, and software providers that include Log4j in their products, such as IBM, Oracle, also VMware, have said that they're all deploying patches. You a Minecraft guy? Any of your kids Minecraft? What's Minecraft?
We're Minecraft people. We're Minecraft people
We're
and some
not.
Roblox. A little bit of both.
I know you're Roblox. I know that. You're going
We
to take
do a little
over.
Minecraft, not Roblox so much, but
So
Not-
what's going to happen? You
Okay.
guys are both compromised then. You better
we haven't-
change all your
it's
passwords.
I don't think it's an active thing in our house at all. So
No?
yeah, it's all right.
We
world.
might be. We'll I'll have to do some work. Meantime, Alibaba in trouble over its response to a claim of sexual assault. The company fired the female employee who made that accusation against the supervisor, accusing her of spreading false information and damaging the company. The woman went public with her allegations over the summer because she said that Alibaba had failed to take action. Her story was shared over the weekend in a lengthy interview in a state-backed newspaper. That was seen as a signal of Beijing's tacit endorsement of the outrage against Alibaba. Now, Alibaba fired that supervisor, but a criminal case was dropped. We've got a lot more coming up on Squawk Box this morning. A big story in the red-hot electric vehicle business, an EV not named Tesla, getting some very high marks from critics. Phil LeBeau is going to join us with the details in just a moment. As we head to a break, we'll look at the SP 500 winners and losers on Friday.
Good morning, everybody. Take a look at the futures this morning. You'll see right now the Dow indicated up by about 103 points. S&P futures up by 16, the Nasdaq up by 68, and this is after a very strong week for the markets last week, with the S&P closing on Friday at a new high. Andrew?
Thanks, Becky. Meantime, Motor Trend's Truck of the Year honor going to an electric vehicle for the first time. Phil LeBeau joins us now with more because the brand doesn't start with a T.
No, it does not, Andrew. It's Rivian, the R1T from Rivian, named Motor Trend's Truck of the Year. And if you're thinking to yourself, wait a second, this has just barely been out, it's the first vehicle from Rivian, you are correct. This is the second time in 2 months that Motor Trend has named a first-time vehicle from an automaker as their vehicle of the year. Remember, it was Lucid with the Lucid Air was car of the year last month. Now you've got the R1T as the truck of the year. Deliveries did begin this fall. And we asked the editor of Motor Trend, look, are you saying that the Rivian R1T is going to be a runaway hit? And he said, well, hold on. We like the truck. We're not making a comment on the company yet.
Truck of the year in this case, it's not business case of the year. We don't know what's going to come. We are hopeful that they're going to have a smooth ramp into full-scale production and get a lot of these vehicles out there and everybody's super happy.
Still, it's a nice feather in the cap for Rivian and the R1T. Look, we have a huge year. 2 years coming up when it comes to electric pickup trucks. You've got the GMC Hummer EV delivery starting later this month. By the way, the R1T beat out the Hummer for truck of the year. F-150 Lightning, the Cybertruck, if we get it by the end of next year. And then, of course, the R1T if deliveries already starting. Take a look at Tesla, Ford, and GM over the last 3 months. As I mentioned, the GMC Hummer deliveries, those begin this month. And that is critical for General Motors. Remember, it's the first vehicle off the Ultium battery platform. And as they ramp up those deliveries in the next year, General Motors is counting on big success from the Hummer leading into the e-Silverado. And as you take a look at Rivian, we're going to go back to the IPO. Remember, this company reports its Q3 final results later this week. It'll happen on Thursday. They give us preliminary results when the IPO happened. We'll get the final results. I don't expect a big difference in the numbers, but it will be interesting to see what RJ Scaringe has to say during the conference call in terms of reservations, in terms of the ramp up in production. So that's going to be the focus on Thursday afternoon, guys.
Well, that's what I was going to ask you. I'm assuming this is going to create a whole new set of reservations, if you will. And then the question is, how quickly can they produce them and deliver them?
Sure. I think it will create more interest. Look, I think they are getting a lot of interest from people who are interested in an electric vehicle and interested in a pickup truck. And that is the first mover advantage that Rivian is enjoying right now. That said, RJ Scaringe and his team have been very clear that they want to be cautious in terms of ramping up production. They're not just going to start spitting them out. They want to make sure that they have everything exactly as they want it as they start the deliveries of these vehicles. And from everything I've heard from people who have received this vehicle, they have been judicious in terms of making sure that they do the right things right off the bat, and they're going to slowly increase their production and deliveries.
Okay. Phil LeBeau, thank you, sir.
You bet.
And coming up, the inflation debate rolls on. Big piece by our friend. We should get him on, Kevin Warsh, in the Wall Street Journal today. We're going to talk rising prices and the potential impact of the Build Back Better bill next. And as a reminder, you can watch or listen to us live anytime on the CNBC app. We'll be right back. The debate continues over President Biden's Build Back Better bill and its potential impact on inflation and the economy. Joining us now to discuss, former Congresswoman Donna Edwards. She's also an NBC News political analyst, and former White House Chief of Staff Mick Mulvaney. He's the founder of Exegist Capital. Congresswoman, welcome. It's great to see you. I love that backdrop. I love that shot. Merry Christmas. Beautiful tree. You too, Mick. Congresswoman, in the Journal today, and it's not specific to the Journal, but that the CBO estimate that some Republicans requested, showing what the actual cost would be if the programs were extended like they are, in all likelihood, that is going to happen. The Penn-Wharton model at $4.6 trillion. Do you have any regrets that maybe the Democratic Party or the Democrats in Congress didn't just sell it exactly for what it is? It just seems like they're trying to hide the actual cost.
Well, I don't think that's true at all. I mean, we're making a big presumption that future Congresses are going to extend all of these programs, and we don't know that to be true. What we do know is that the ones that are factored into Build Back Better, some of them have shorter time frames, and it brings the cost to where it is. And so I'm not worried about that. I'm more concerned that Democrats just need to pass the doggone bill and get out there and sell the components that the American people care about to the American people. And so that's my major concern. It's not over time whether some programs will or will not be extended. I was in Congress, and I know you cannot project from one Congress to the next what's going to happen. That's
true. And I know that Senator Schumer and Speaker Pelosi both said that they would offset that still, so that they would say that it's not costing anything because there'd be tax increases. But now you're talking about definitely future tax increases every year if the programs are extended, and I can't see how they wouldn't be. Mick, I want to start with you with this Kevin Warsh piece, who basically saying that it's the Fed's fault that we have this inflation, but the reason the Fed is in a box is because Jay Powell is going to be really unable to raise rates because we keep adding to our growing debt, and he's going to be in a box. The debt service would be so high at that point that you're definitely going to see it impact the GDP. It all seems like a witch's brew of not great things if we keep spending at this rate.
Well, it's a vicious cycle, right? When we were at $20 trillion worth of debt at the country and the interest rates were about 2%, even I can do the math on that. We had a $400 billion tax bill. When you go to 30 trillion and they say the Fed wants to raise interest rates to say 6%, that's $1.8 trillion worth of interest only. So yeah, the Fed really is in a box, but they're mostly in a box. Let's be honest, because Congress put them there. If the national debt were zero, there'd be a lot more flexibility towards the Fed. Don't also discount, I don't think Kevin mentioned this, the fact that Fed is politicized now with both parties watching so closely whether or not Jay Powell got renominated and will get reconfirmed. You've got folks like AOC saying that she thinks that Biden should be focusing more on having the Fed work on racial justice. So the Fed is becoming politicized as well. But we're in the box because of the size of the debt, and this bill just adds to it. You're absolutely right. Let's say that the pre-K thing only lasts for 6 years and that another Congress wants to extend it. That means they'd have to raise taxes without giving anybody anything that's new. That never happens. What happens is something goes in now for 6 years and then it automatically gets extended and then it's simply added to the debt. Don't lose track of the fact that the only reason many of these programs are so short and Build Back Better is that originally longer and they cost more. So they need to shorten them just to satisfy Joe Manchin. So there's not sort of like an intent by the Democrats to do a short-term project. They want these things to be permanent. They just couldn't afford to pay for it.
And Congresswoman, that's what I thought of when you said I don't have a problem with it. We just need to pass, or Democrats just need to pass the darn thing. Manchin is the stumbling block. And when he sees a print on inflation like we saw last week, the highest in 39 years, the difference between Virginia and West Virginia, I know they share a border, but they are different places. And he's got constituents there that notice things maybe more than some states that are bluer. And I don't, you need him. You can't just pass the damn thing if Joe Manchin doesn't got, and he's drawn certain lines in the sand that are in this bill that would have to come out, and then it would have to go back to the House. So it just seems like a hard thing to imagine before the end of this year.
Well, I do think that there are things that West Virginians do care about. They care about universal pre-K. I mean, if you look at West Virginia in terms of where it stands on education, universal pre-K would help tremendously. They care about child tax credit and the child care provisions. These are things that actually help working people. Medicaid expansion, lowering prescription drug cost prices. These are things that West Virginians and that Americans care about. And I do think that there is a way to accommodate Joe Manchin's concerns. Those are things that he's expressed an interest in, and to move a package forward that's going to make a difference, not just today, but in the future.
What do you, Nick, what's the timeline for you and probability for you on how this, what is it, the 13th? I was shocked it was already the 13th because.
That's right. Don't forget, this is how the timeline works. It's already passed the House. If the Senate passes exactly like it is, then it can go to the president's desk whenever. That's not going to happen. It's going to change at some point in the Senate. So we'll have to then go back to the House. And I think Joe Manchin and others, it's not just Joe Manchin, there's plenty of folks, including the Democrat Party, are looking at this saying, okay, my folks back home might care about pre-K, but they really care about the cost of gas. They really care about the cost of turkey for Thanksgiving and ham for Thanksgiving. They don't really care about money for salmon, which is in the bill. They don't really care about money for news networks, which is in the bill. And I think what you're hearing from Donna, and listen, we both do it, Republicans do it when they're trying to pass a piece of legislation, Democrats are doing it now. Pass the damn thing quick so no one knows what's in it. That's what this is really all about. Yeah. What can we do over Christmas so that no one has a chance to really digest it, to figure out what they don't like in it? Look, at the end of the day, something will pass and then the voters will decide. Do they really care more about pre-K or the earned income tax credit, or they really care about the price of gas? I don't think passing this or not passing this changes the fact that Republicans take control of the House and probably control of the Senate in November of next year.
Congresswoman, you can either just respond or I can just, I don't know. There are a lot of things that if you did wanted to, like, I certainly could see, what do we got? K through 12. I could see K through 13 or N through 13, whatever you call the child care before K. I could see that, but just piling it all on. This is like 40 years of Democratic wish lists. In a 50-50 Senate and in a House where Democrats lost seats with poll numbers that don't look great for 2022, just seems like a bridge too far to be trying all this right now. I don't think the American people necessarily are on board. Sure, they love free things. If you ask someone a question, hey, would you like this free stuff? They say yes. But they also think that maybe government is getting too big and overreaching, and they don't necessarily want it to do that like a Europe. An entitlement state?
Well, it's not about free things. It's about, passing legislation that's going to make a difference in people's lives when they go to work, when they send their children to school. There are significant climate change provisions in Build Back Better. And as you've done the reporting on the horrible tornadoes in Kentucky. And these changes in the climate are really contributing to tornadoes in the middle of December. So I do think the American people care about those things that are impacting the economy. And that is not to say that they don't care about the cost of, you've done the reporting on clothing and all of their consumer goods. We know the pressures of inflation, but I also believe that those pressures are being created because we haven't, quite moved beyond COVID. And so getting people vaccinated, getting people back into the economy. There's strong job growth. There's every indicator that the American people will do just fine. They'll contribute by working and paying taxes, and we need to make sure that they have the tools they need to participate in this economy.
Mick, November's a long way off. Actually, it's not.
No.
Seems like it. No, it's not. But in political terms, it is. In terms of our country and how quickly we can. I mean, when was inauguration? That was it's not even a year. God almighty. And look where we are. So by a year from now,
really quick, Joe, I think is what we're talking about here.
Well, the pendulum could go all the way back. What do you think the prospects for 2022 are in terms of the House and Senate?
Oh, I think they're pretty good. The conventional wisdom is they should be good anyway, right? Any president into his first term usually loses seats in the House. But that combined with a bunch of other dynamics, I think everybody pretty much knows or assumes, knows, you never know anything at this point, assumes that Republicans are going to take the House. That's why you're seeing so many retirements from so many high-ranking Democrats. There's nothing worse in the House from going from being a chairman to a ranking member, especially after you've been there 20, 30 years, chairman, a very powerful, they have huge staffs, and ranking members, which is the highest ranking member in the minority party, don't. So it's a miserable sort of demotion. That's why you're seeing, I think, 19 or 20 retirements. We saw the same thing, by the way, in 2018. So it's the ordinary cycle of things. But your point is a really good one, which is, should we really be having this type of massive progressive programs debated in a Senate that's 50-50? You can't stop it from happening. But when the Republicans have a narrow majority coming up in 2022, what will they be coming up with? Both parties are moving further out to the fringes. The Republicans moving further right, the Democrats moving further left. It's becoming more and more difficult to strike any sort of compromise in Washington, D.C. I don't see that changing in November 2022, even though I do think the Republicans take the House and the Senate.
Okay. Want the last word, Congresswoman?
Well,
Quick
look,
one.
I think it's going to be a tough year coming up in 22, and everybody acknowledges that. And the best thing that Democrats can do is to continue to govern, continue to make sure that they're doing things to the American people and communicate that to them, and mitigate whatever harm might be projected to happen in 22. Anyway, look, we're going to go through our holiday season, and then it's going to be full on campaign season from January forward. Happy holidays, Merry Christmas. I know I'm celebrating, so I hope the American people will too, and then we'll get started in 22.
Thanks, Donna. Merry Christmas to you as well. It's good to see you again.
Someone
You too.
surprise you with some new art, Donna? I mean, is that, do you know what's in that package on the wall?
You know what? I wrap my art in wrapping paper because it makes me feel more festive.
That is festive as heck. I gotta say, it looks like one when I get it done. Whenever I buy something, I get it done at the department store. Like I wait for like an hour because I don't know how to do it, and that's better. That looks better than the ones I get at like a Bloomie's or something like that.
You still go to department
Well,
stores?
thank you.
How old are you? Still going to department stores? No one does that anymore.
I do not. I'm not a big online shopper. How do you get the credit card in the? I just don't know how to. Do you put it where the disk drive is? How does that? I don't even know how that. I don't even know how that works. Yeah, I know a Luddite. Thank you both. Appreciate it.
Merry
And
Christmas.
happy holidays. Okay, Merry Christmas.
And Mick Mulvaney is doing my job for me, Joe. I mean, it's really quite extraordinary. Coming up when we return, Steven Spielberg's West Side Story with a lackluster opening weekend at the box office. What it all means for theater chains and streaming stocks. We'll talk about it. Here's a look at crypto in the red this morning after a bit of a rally over the weekend. You're looking at Bitcoin at $48,842. Squawk Box returning right after this. Welcome back to Squawk Box this morning. Steven Spielberg's remake of West Side Story came out this weekend to a somewhat disappointing opening. Great reviews, but only grossing $10.5 million. Box office performance still in a massive slump from pre-pandemic levels. So far this year's domestic gross was $3.6 billion compared to over $10 billion in 2019. Joining us right now to discuss all this and more is Matthew Bellany. He is Puck News founding partner. Matt, it's great to see you. And I should just say, before we even begin, I've been reading your newsletter religiously. It is a lot of people have started newsletters in the past 12 months on all sorts of platforms, Substack and the like. You've done it with Puck, but yours has become a singular must read for me. So congratulations to you on all the success you're having. It's beyond what you're writing. It's like every time I open it. But let's talk about what happened to the box office this weekend, and specifically this Spielberg film. And I guess it raises the following question: should have they just put it out on a streamer?
Well, that's the big question, because there is an answer. They actually couldn't. This is a film that Disney inherited from Fox in the Fox transaction, and those movies have an output deal with HBO, so they have to go to HBO first. So a number of these Fox movies that Disney has sort of been quasi stuck with, they've put in theaters and they've disappointed. Now, there's another aspect here in that Steven Spielberg probably would have thrown a fit if they had tried to put this movie onto a streaming service without giving him a theatrical release that he is accustomed to. So Disney, the film cost, they're saying it cost $100 million. I've heard it's more, but they went for it and they tried to release it wide. It's a weird date because it's before the holidays. It's not in the holiday corridor, and it just didn't work.
And what's the larger view that you have now of in theater films? What works, what doesn't, and to any degree, does it even matter where we are in the pandemic?
It does matter. It's shown that where we are in the cycles of spikes and valleys and Omicron and Delta does seem to matter in these territories. But the one genre that consistently does not work is adult-oriented dramas and musicals, things that require an older audience to attend. And we saw domestically, a quarter of the audience for West Side Story was over 55. And if your movie is targeted towards those types of audiences, you're not going to get them to theaters in any mass like you would pre-pandemic. The ones that have been working are the comic book spectacles, the shorter, punchier, audience-driven that are younger, but not necessarily families. Family movies have also struggled because children until recently have not been vaccinated. But if movies like Venom 2 or Spider-Man, which is coming out this weekend, movies that would have done well pre-pandemic as well, but they are kind of drawing those audiences back. And we could see a massive Spider-Man opening this next Friday.
So, but take us inside Disney right now. Take us inside the corner office of all these places. Is there a new thought in terms of how to approach this?
They're very frustrated with this because they know that West Side Story could have been a big event film on Disney Plus this holiday season. They didn't have that option. They could have done some master deal. They chose not to. But I mean, think about West Side Story. It would have been a Hamilton-style event on Disney Plus. Instead, they went into theaters, and this isn't just the U.S. It disappointed globally, 4.4 million in 37 markets. That's not good internationally. They want
Matt, is that a forever?
As much as they can to streaming.
Is that a forever situation? Is this a post-pandemic? I don't know. Or do you think this is pandemic specific still?
Well, I think it's pandemic specific still for the larger question. There is a question of whether there are some moviegoers that are forever lost. There was a study recently that said 8% of moviegoers are forever lost, will not be back. And I think that's a significant number. But I do believe at some point the box office will recover. We don't know what that new reality will look like, but it probably will look a lot better than it does right now.
Matt, it's great to see you. Congratulations on the newsletter. It's on Puck. Look forward to having this conversation with you again. You bet. Absolutely. Becky?
Thanks, Andrew. When we come back, British Prime Minister Boris Johnson warning of a tidal wave of Omicron and telling people to work from home today. We're going to get an update from Dr. Scott Gottlieb straight ahead. In the meantime, check out the futures running higher once again today. Dow futures indicated up by 68. The Nasdaq indicated up by about 60 points, and the S&P, which set a record on Friday, indicated up another 12 points this morning. You're watching Squawk Box right here on CNBC. Good morning. Stocks starting this week on a high note, with Apple closing in on a $3 trillion market valuation. The Fed back in focus with a two-day policy meeting on the agenda. Steve Leisman will join us with what investors need to be watching. Plus, boosters, variants, studies, mask mandates, and testing for all. Dr. Scott Gottlieb will help us make sense of this morning's COVID headlines. The second hour of Squawk Box begins right now.
Good morning and welcome back to Squawk Box right here on CNBC. I'm Andrew Ross Sorkin along with Becky Quick and Joe Kernan. Let's show you the U.S. equity futures on this Monday morning. Still about 2.5 hours before we're set to open, but things looking up. Dow up about 62 points, SP500 up about 11 points, NASDAQ looking to open about 58 points higher. We're also watching shares of Apple this morning, closing in again on that $3 trillion market cap. The stock up 35% year to date and nearly 20% just in the last month alone. Based on the 16.4 billion shares that are outstanding as of October 15th, stock price of $182.86 would give Apple a $3 trillion market cap. So we are oh so close, Joe.
Yep, we are very close. It could next time we check it could be there. Making headlines this morning, Pfizer's buying Arena Pharmaceuticals for $100 a share in cash. That's $6.7 billion. They can afford it. It's a roughly 100% premium to Arena's closing price. Becky.
Let's get to Washington right now and the latest on the Build Back Better bill. Elon Moy joins us live from the nation's capital. Elon?
Good morning, Becky. Well, Democrats are trying to wrap up work on their social spending package this week in hopes of delivering passage in the Senate by Christmas. President Biden's getting involved. He's planning to speak with Senator Joe Manchin in the next few days. Inflation likely to be on the agenda, as well as a CBO's projection that Build Back Better would add $3 trillion to the deficit if it were made permanent. To help combat that narrative, the White House sent out a messaging document over the weekend focused on the ways they say their plan would lower costs for childcare, elder care, and for health care. The lawmakers are also still trying to figure out how to handle the cap on state and local tax deductions. Democrats have now released the legislative text of their tax plan, and it literally just says placeholder for compromise under that part of the bill. We know other changes are likely as well. Some senators are trying to revive those IRS bank reporting rules, for example, and both parties are slated to meet with the parliamentarian this week to argue over whether the package complies with the Senate's arcane rules. Getting all of this done by Christmas feels like a heavy lift, but guys, Democrats do seem determined to at least try. Back over to you.
Elon, there are some complications. If this isn't passed, I think, by December 28th, then there's no way that checks are going to get sent out to families in January, the continuation of some of those programs that the Democrats wanted to move forward with. But it kind of all comes down to Joe Manchin. And if he's not in a hurry on this, and there was some speculation and some commentary over the weekend from Lindsey Graham, who said he had talked to him, that those higher inflation numbers that we saw last week are something that are making him feel like he does not need to move quickly on this.
Yeah, Republicans are applying pressure on Manchin as well. It's not just the inflation numbers, but it's also that CBO score of the permanent Build Back Better. Lindsey Graham said that Joe Manchin was stunned when he saw that it would add $3 trillion to the debt. Though, of course, the biggest portion of that is the child tax credit, which both parties have supported in the past, making that bigger and lasting for longer. So, we'll see if the president is successful in counteracting the Republican narrative over the past few days. But clearly, Joe Manchin is under a lot of pressure and does not feel the urgency to move at this moment.
Elon, thank you.
Okay, meantime, the big market story this week is, the Fed, once again, the central bank meeting this week with the market expecting a faster taper. But is that all that investors should expect? Senior economics reporter Steve Leisman joins us now with his take. Steve, good morning.
Morning, Andrew. Yeah, another strong inflation report with promise of more to come last week raises the question of whether the Fed may have to do much more to get control of rising prices, not just taper faster or even raise rates earlier. Markets already expect that, but actually move to slow the economy. Here's a preview of tomorrow's Fed survey. We asked if the Fed eventually could have to raise rates above neutral to slow the economy. 45% now saying yes, 55% said no. Rapid changes in the Fed's own policy outlook mean that most forecasters are only now catching up to where the market is. They brought forward their estimate of the first rate hike into the spring or early summer. But is that enough given the current inflation outlook? Bill Nelson, former senior Fed staffer, now chief economist at the Bank Policy Institute, writing this weekend, the market implied path for expected overnight rates and the probabilities of higher paths for rates are too low. The committee is already tapering at twice the pace it did in 2014 and seems prepared to start tapering at quintuple the pace. Expect a similar degree of rapidity when it raises its target Fed funds rate. The warning is that the Fed itself might appear even more aggressive in the projections to be published on Wednesday. The real Fed funds rate, which subtracts inflation, 6.8% or minus 6.8%. That's the lowest on record. The Fed has an awful lot of work to do to get to neutral, and even more if it's going to try to slow the economy. The question is whether markets have priced that risk in. Andrew?
Did you get a chance to see, we were talking about it earlier, this Kevin Warsh op-ed in the Journal today, where effectively he blames the Fed.
Yeah.
I mean, he's been blaming the Fed for quite some time to some degree on this issue, but is he right?
I think the Fed played an important role in the current inflation that's out there. I think it's an interesting question to ask when it should have hiked, given the uncertainty over COVID. I think analyzing policy in real time is a little more complicated than looking back and saying the Fed should have done X. But, President Trump did a $4 trillion spending bill. Biden did $1.9 trillion. Which one of those should the Fed have leaned against with its policy? At what point in time should it have done that? I think the argument, and I've made this argument going back to Alan Greenspan and his rate hikes after 9/11, which is that if a Fed gives an emergency rate cut, it ought to be able to take it back in an emergency way. The Fed didn't do that. I think Powell went all in on $120 billion of QE. It was an awful lot. I think maybe he went a little over the top at the beginning. So yeah, you add the fiscal side, you add the monetary side, and you add some things that were not predictable, the endurance of the supply chain disruption, and you have a recipe for high inflation that looks set to continue for the next several months at least.
Before we go, help answer this question. He writes, achieving a soft economic landing at this stage is difficult. I expect tension between the Fed's goal of price stability and financial stability to be in sharper relief in the new year. Which is going to win and how quickly?
It's not a quick question, Andrew. I know you got to go, but it's very difficult. I think the Fed will always side with financial stability. I think that's, somebody wrote this weekend that the Fed main job, and the only thing it actually does well, is to back up financial stability. So I think that will ultimately win. But the Fed has to really thread a needle here by trying to get control of prices while maintaining financial stability. I think Kevin has framed it well in that regard.
Mr. Leisman, thank you for the analysis. Appreciate it. When we come back, a lot more on Squawk Box. Sarat Sethi is going to be joining us to talk about the stocks we should be watching this morning. But first, as we head to a break, check out some of today's biggest pre-market Dow leaders and laggards. Stay tuned. You're watching Squawk Box right here on CNBC.
Welcome back to Squawk Box. We are watching shares of Apple this morning as the company nears a $3 trillion valuation. Joining us now, Sarat Sethi, Managing Partner, Portfolio Manager at DCLA. He's also a CNBC contributor. Earnings season's mostly over. Sarat, we got that hot CPI number. The Fed seems like it's bringing in the timetable for when it tapers. And we've got a variant with all that conjecture swirling around how that's going to affect things. Do you have a market mood ring? Can you look down and does it have a reading for how you feel, how bullish you are or bearish?
So, Joe, what I'm looking at are really specific companies at this moment. I mean, if you look at just last week and you had Oracle and CVS report, stocks that nobody cared for 6 months ago, they had very strong earnings and the stocks really reflected the earnings. I mean, price action was really positive. And I think what investors are very discerning at this point, and we're going to look forward and say the market might not go anywhere at the high level at the S&P, but underneath you're going to see a lot of movement. And for example, this week FedEx is reporting, and if you remember a few months ago when they reported, they had a really bad quarter in terms of costs, in terms of just getting people to work, wages. So I think that's also going to be important for this week to look and say specifically what are some of these companies reporting, and how is that going to be a see-through to the rest of the economy?
So you're agnostic about the averages. You have no opinion on whether is there a bubble? Is inflation a problem? Is the Fed a problem? Is just, I mean, it's easy to just sit back and talk about individual stocks. Are we extended in the markets? How will 2022 be in terms of a market return for the S&P? So, right, you have an opinion?
Well, yeah, I do. To answer your question, I think the S&P is up 5 to 7%, and it's going to be driven mainly by sectors that have not performed as well. I think the big cap, large cap stocks will do fine, but I think the multiple expansion for some of those earnings will have to catch up. I don't think you're going to get this 25% return because so much of that was just a valuation issue. It was really your PE expanding. So where you're going to get the biggest bang for your buck is going to have to be playing in areas that, haven't worked in the last 18 months. It's not going to be the stay-at-home stocks. It's not going to be your Pelotons or some of the other cloud stocks. It's really going to be other stocks that haven't carried the index. But I don't think you're going to do badly. I mean, look, at this point, there's nowhere to go. The 10-year is back to 1.4. So investors aren't moving money into bonds per se. They're really looking for opportunities. And at this point, the large caps are really your bond proxies, your Apples, your Microsofts, your Googles. You're not going to get hurt by them, but I think there's going to be much more opportunity in other parts of the market.
Seems like people are moving into bonds. If the rate goes down from 1.6 to 1.4, they're not selling bonds.
They're not selling bonds, but I think what you're also seeing is that people are not really clamoring in for them. It's just more of a, hey, where are we going to be, down the road? And really, I think at this point, you're not going to get much bang for your buck hiding out in a 10-year.
What do you think about next year for the 10-year? What kind of range are you expecting? Is a little bit of an increase in rates, would that be representative of a good economy if we went to 2%? And is that fine? Is that cause for concern with the stock market, or is it something to celebrate?
I think it would be a good thing, Joe, because if the short-term rates are going to start moving up, the worst thing we want to see is a flat to inverted yield curve. And I think right now, the way things are going, the yield curve is pretty flat. I mean, it's still upward sloping. So we do need that to go up. That's going to be a reflection of the future pricing and the future growth of the economy. So 2%, 2.5%, I think the market can handle it. Now, your high valuation stocks might have a hiccup here and there, but I think that would be a very good indicator for the future of the economy, future for the stock market as well, because it will say things are healthy when you do a forward-looking indicator on the 10-year.
So we're behind the curve, the highest inflation in 39 years. It robs purchasing power. It takes away any wage gains that we've seen from people that need to buy food, need to buy gas, need to pay for heating.
Yeah. I think some of these where you're hitting their rents, wages are more permanent right now. And I think going forward, those are going to be very hard to come down. Supply chain issues could be somewhat transitory, but even those, the longer that we have, COVID around, those are going to become more permanent because companies are going to, not single supply. So yes, I think, we do need to raise rates or at least get the tapering done, because you have so much liquidity in the market. There's no clearing price on a lot of the credit markets and also some of these stock prices. So I think that is, one of the reasons when you ask where's the market going to be, I don't think it's going to be up huge. I think it's going to be individual sectors and stocks, and that's going to be just dependent on earnings growth and not just valuation expanding.
Okay, great. Surat Sethi, thanks. Happy holidays. We'll probably see you maybe before the end of the year. But thanks for being with us today, Surat.
Thank you, Joe.
And some breaking news from Harley Davidson. Morgan Brennan joins us now with the details. Morgan, were you a Sons of Anarchy fan? Could you see those guys? Could you see those guys on a motorcycle going with no sound? I mean, is that, can we pipe in the sound of a hog on these things? Or, I mean, who wants this? Go ahead, tell us the news.
I'll tell you, that's been a debate. The fact that you don't get that vroom, vroom, vroom sound with these electric motorcycles for a number of years now. It's actually part of the reason. I think back to 2014, standing outside of here in front of the New York Stock Exchange and actually seeing that first live wire prototype from Harley Davidson. And it was being toured around the country specifically to see if consumers would be interested in it, given the fact that it wouldn't have that room. There is a market for it. That's the news of the day. Harley Davidson is announcing that this electric brand Livewire will merge with a SPAC to become the first publicly traded EV motorcycle company in the U.S. The deal with AEA Bridges Impact Corporation, ticker IMPX, is going to give Livewire a pro forma enterprise value of about $1.8 billion, post-money equity value about $2.3 billion. Harley will remain the majority shareholder. CEO and chairman Jochen Zeitz will also become chairman and serve as acting CEO of Livewire for up to 2 years once this deal closes. It's expected to raise $545 million. That includes a pipe of $100 million from Harley, also $100 million from Taiwan-based power sports manufacturer Kimco. And Livewire, as just mentioned, this is a business 10 years in the making. It's going to benefit from at-scale manufacturing and distribution capabilities from Harley and Kimco. That's according to Zeitz. Currently has a presence in North America and Europe, plans to expand into Asia and other markets. The company's forecasting a dramatic ramp in EV motorcycle sales over the next 5 years, profitability actually expected in 2026. So for Harley, the motorcycle icon is in the midst of this multi-year turnaround strategy known as the Hardwire. This deal would enable more investment in both that core business, also EV, and the tech expected to filter back to that core Harley portfolio over the longer term as well. Deal's expected to close sometime in the first half of next year. And Jochen Zeitz will join me exclusively in the 10 a.m. Eastern hour of Squawk on the Street. As you can see, shares of both the SPAC and Harley are trading higher on this news, Joe. I'd also just note, at least initially for EV motorcycles, very much an urban market or an urban consumer, at least to start.
Same kind of acceleration. I mean, a normal motorcycle has acceleration that, you know, sometimes it seems like it can almost go out from under you. Same deal here?
Very similar, and they have a number of motorcycles that are both on the market and in the works. This is going to enable an even bigger, fuller product line. We'll see where it goes, Joe. I'd also just note it's coming at a very interesting time, given the fact that it's been a rip-roaring year for EVs overall.
Is the carbon footprint of hogs something that we really need to be concerned with? I mean, is there a reason? I guess, you know, maybe there won't be any gas stations left someday, but...
well, I mean, gas prices are high, right? So that's a piece of it.
I don't know. I think I can afford to fill them.
$5 a gallon.
Even with what I make, I can afford to fill a motorcycle tank, I think. I don't Anyway,
well, I just think it speaks to this future that is coming across different types of vehicles towards an electric future. So I will ask Zeitz all about this a little bit later this morning. I'll report back to you, Joe.
I ain't not getting on a Boeing electric plane, okay? Maybe I'll buy one of these motorcycles, but, you know, put some jet fuel in my jet. Thank you, Morgan Brent. That's just me. See you later.
Okay.
One run on cooking oil. How'd that work for you? Maybe not. When we come back, British Prime Minister Boris Johnson says that at least one patient has now died with the Omicron COVID variant in the UK. He is warning of what he calls an Omicron tidal wave facing the nation. Dr. Scott Gottlieb will join us in the next half hour. Stay tuned. You're watching Squawk Box, and this is CNBC. Welcome back to Squawk Box. Last week was a big one. You had all of the major averages up by more than 3.5%. The Dow, in fact, up by 4%. And the S&P setting a new record. And this morning, those green trends are continuing. We're off the highs of the morning, but the Dow futures still indicated up by about 44 points, with the S&P indicated up by 11 and the NASDAQ indicated up by 63. On the Treasury market side of things, you're going to see that at least for now, yields are still under some pressure. The 10-year right now sitting at 1.47%. Andrew?
Thanks, Bex. Meanwhile, we are watching shares of Apple this morning, closing in on $3 trillion market cap. It closed so close on Friday. The stock up 35% year to date and nearly 20% in the last month alone, based on 16.4 billion shares of outstanding shares as of October 15th. The stock price, you can monitor it on your screen right now, of $182.86 would give Apple that $3 trillion market valuation, Joe.
Yep. Really close. Now, coming up, all cash deals are the lifeblood of the luxury real estate market, but now they're coming under scrutiny. Robert Frank is going to bring us that story when Squawk Box comes right back. Welcome back to Squawk Box. We are looking at luxury real estate this morning. In Manhattan, in Miami, more than half of all sales are done now in cash without a mortgage or a loan. And in resort enclaves like the Hamptons, Aspen, and Jackson Hole, it's even higher. But now some of those deals are coming under scrutiny. Robert Frank joins us with the story. Hey, Robert.
Good morning, Joe. More than $2 billion has been laundered through U.S. real estate over the past 5 years. Now the Treasury Department is going to crack down. The agency's financial crimes unit proposing new rules that could require real estate brokers to report more information about all cash deals. The Treasury Department is saying, quote, the systemic money laundering vulnerabilities presented by the U.S. real estate sector, and consequently the ability of illicit actors to launder criminal proceeds through real estate threatens U.S. national security and the integrity of the U.S. financial system. Now, the real estate industry already pushing back against this proposal, saying it could stifle the market. About 20% of nationwide sales are cash. That's over $400 billion a year. But as you mentioned, it's even higher in luxury markets. In New York, nearly half of the deals are in cash. In Miami and parts of LA, it is over 60%. Now, this would come on top of an existing Treasury program that was launched in 2016 that targets shell companies in real estate. About a third of the deals in that program were flagged for suspicious activity. There have been over 50 prosecutions or charges over the past 5 years, including the vice president of Venezuela buying $7 million in Miami condos and a Russian gang laundering over $200 million in New York real estate. And guys, they're talking about residential as well as commercial with this proposal. So this could be huge for both the commercial and the high-end real estate market if it goes through. Right now, it's just in the public comment phase.
Robert, in terms of I understand the way they're doing it. Are the prices exorbitant? Are they reasonable? What do we have in terms of are they getting value for the money? I would imagine that we're nowhere near the peak of where things could go in the roaring 20s that we're looking at someday.
Yeah, I mean, one of the reasons that U.S. real estate is so attractive to laundering is that, number one, it's a stable investment. And as we've seen in this crisis, you know, Manhattan went down, but now it's come back. So that's terrific. And secondly, it's opaque. The U.S. is the only country in the G7 where real estate brokers are not subject to money laundering rules. And so that's what they are hoping to fix through this rule.
Well, we're going to have some increased scrutiny, I think. Would this be part of it? Would we need some IRS agents to look into this in this bill?
Yeah, I mean, look, one of the ways to look at this is if they can't raise taxes on the wealthy, and if they don't get this $80 billion in added funding to the IRS, they can do it through rules. And this would be a nationwide look at all cash transactions. We don't know if it's going to be just deals over $1 million, so just to the luxury real estate end, or whether it's going to be all transactions. So this could be a rule that takes the place of, or is in addition to, that renewed IRS scrutiny that they're hoping to get through both funding and more agents.
All right, Robert Frank, thanks for that report. Bye.
When we come back, Dr. Scott Gottlieb on the morning's top COVID headlines, including a study on boosters and Omicron, hospital case counts, mask mandates, and one university that's using vending machines to try and get students free COVID tests. First, though, as we head to a break, check out some of this morning's biggest pre-market movers. You're going to see Fortinet at the top of the list, BNY Mellon there, too. Stay tuned. You're watching Squawk Box, and this is CNBC.
Welcome back to Squawk Box. The futures, at least the Dow, has been kind of drifting from some of its best levels of the pre-market session. Now you can see up about 26 points. NASDAQ still doing pretty well, up 63. S&P up about 10. Treasury yields closing in on that 1.5. I don't know, 1.47, kind of right between 1.45 and 1.5. And we'll see whether we'll see what next year brings. I'm already looking at the at what's happening and some of the forecasts that we used to do. Remember, Andrew, I asking Surratt, what do we think at 20? It's time. 12 days to Christmas. 12 days. 12 days. Hope you're
Santa Claus rally or no?
Doesn't that happen? That usually means the week after Christmas, doesn't it? I don't know. What did we decide the tax moves should be for all these big gains that we have?
I don't know.
People have. I mean the royal we. I don't mean us.
Not us.
No.
Yeah.
I don't know. There will be, and then I guess we got to see exactly. We'll see what happens with the. I can't keep saying build back better Bill. I sound silly saying that because build sounds like Bill.
Pickled peppers.
Andrew.
Meantime, let's tell you about a couple of analyst calls of note this morning. Coca-Cola upgraded to overweight from neutral at JP Morgan. Its price target increasing to $63 from $59. Meantime, JP Morgan naming Apple top 22 pick. The firm raising its December 22 price target on that tech giant to $210, would clearly then be a $3 trillion company. That's a street high. The analysts arguing, quote, most of the revenue and earnings upside realization associated with the iPhone 13 cycle still to come. Becky.
Thanks, Andrew. New overnight, British Prime Minister Boris Johnson warning of what he's calling an Omicron tidal wave and urging people to work from home today. The Prime Minister also accelerating the country's eligibility plans for booster shots. And joining us right now is Dr. Scott Gottlieb. He's former FDA commissioner and a CNBC contributor who also serves on the boards of both Pfizer and Illumina. And Dr. Gottlieb, I have to say, this warning from Boris Johnson is making a lot of people kind of sit up and take notice. How do you think this, what does this mean, especially based on what we've seen out of South Africa to this point?
Yeah, look, it's deeply concerning to see the British take this stance because they have very good data, they have very good systems in place. And so if they're seeing a very significant threat from Omicron, I think the world should really take notice of that. We are seeing some indication of a slowing of transmission in Johannesburg and Pretoria, the hard-hit Gauteng region of South Africa. And if that's true, that's going to cause us to have to reassess some of our early assumptions, either when this first began, the transmissibility, which seems to be confirmed by the data out of the UK, or whether or not there's some subcomponent of the population that's excessively vulnerable to this virus. And after the virus burned its way through that population, it started to slow down. And the most obvious would be people who have Delta immunity, but no other immunity, because there is some indication that a lot of the early infections, in fact, most of the early infections in South Africa were people who had Delta, but perhaps weren't vaccinated. And there also is some indication that people who had 1351, who were infected with the old South African variant, may have been better protected against this new variant. But looking at what's happening in the UK right now, where they're seeing rapid acceleration, albeit off a very small base, and they're looking at the data, their own data, which is very good data, and are very concerned that this is going to sweep across the population. That should give the world some pause about what this could mean for other countries.
Just here in the United States, according to NBC data, you're looking at some really big upticks in COVID cases, not Omicron. This is like COVID in general, just the positive test responses coming back. Rhode Island up 140% in 2 weeks. You've got Vermont up 132%, gains of over 100% for West Virginia, Illinois, Oklahoma, Connecticut, New Jersey, all about 95%. I mean, those are some big spikes. Is this what we anticipated because of the holidays, or is this more concerning than that?
No, this is the Delta wave sweeping across the country. And the two parts of the country, the two regions that really hadn't had their Delta waves yet, were the states around the Great Lakes, Minnesota, Wisconsin, Michigan, which have had a very dense Delta wave in recent weeks and now is starting to peak, and New England and the tri-state region. I think we have the answer to the question of whether or not the tri-state region was going to be largely impervious to Delta because of the high immunity here. It's not. And so we're seeing the last part of the country that really hasn't had a Delta wave now have that Delta wave. So the South, the Southeast, the Southwest, the Pacific Northwest, most of the mountain states and the Great Plains have really been through their Delta wave. Cases are ticking up there. So the national numbers are going up, but they're ticking up because of the holidays and the cold weather. So even in places like Florida, where prevalence has been very low, you're starting to see a tick up. I think what's concerning about the UK for the US is the UK has a very similar composition of immunity to the US. There was some speculation that perhaps we were going to be more impervious to Omicron because of our high rates of vaccination and boosters, people who've been infected and vaccinated. But when you look across our composition of immunity, especially when we're done with this Delta wave and 90% of the population has either been infected or vaccinated, it's very similar to the composition of immunity in the UK. So if the UK has a bad experience with Omicron, it's a good indication that we're going to be at risk as well.
Yeah, that's what I was wondering, Scott. If I don't know what the effectiveness numbers really are. I saw 23. I don't know whether that's true for Pfizer, but let's just assume that you're double vax. Maybe you got in the booster, maybe you haven't. But let's say that there still is a lot of Omicron spread and infection over in Europe. If the cases are mild to moderate, but you really see a big spread because it's highly transmissible, and we're back to hearing, it's doubling every whatever that, you see some of these numbers that say it, that are concerning. If it's mild to moderate, what does Europe do? And I guess that we're down the road and we'd have to figure that out too. We have to decide too, but will it be a full-fledged wave, another COVID wave?
Well, it could be a wave without the extreme death and disease that we've seen from other waves, and that's the hope. The vaccines right now, if you look at the data out of the UK, and albeit it's only on about 600 patients, the 2 mRNA doses look to be about 40% protective. 3 doses seem to be about 75% protective against symptomatic infection, which is quite high. It means that we're not going to lose these vaccines. And we now have other data points that suggest that range of protection in about the same area as 75%.
Do we quarantine? Let's say you're in Europe.
Well,
I'm asking for a friend. I'm asking for a friend. Let's say you go to Europe, you get Omicron. It's mild to moderate. Do I quarantine for 12 days or something? Am I stuck? Are things going to happen like that?
This is the concern right now. The concern is that the reason why we're seeing mostly mild infections and asymptomatic infections with Omicron is because it's infecting a largely immune-exposed population, a population that has immunity either from prior infection or from vaccination. And so you have protection. What worries us is that if it sweeps across the population and becomes widely epidemic, it's going to find its way into pockets of vulnerability. And the biggest pocket of vulnerability in the U.S. of people who have preserved immunity, meaning that they don't have any immune protection either from prior infection or through vaccination, are children under the age of 18. Only 25% of children under the age of 18 have been vaccinated. Most of them are teenagers. Only 26% of kids under the age of 18 have been infected. And again, most of them are teenagers. We've done a good job of preserving toddlers and young kids and keeping them from getting infected. So if this does become widely epidemic among adults, you have to worry about those immune naive populations, and it's primarily children. You also have to worry about vulnerable people. Vulnerable people remain vulnerable regardless, even if they've been vaccinated. People who are immunocompromised, older individuals. And so if you infect enough people, law of averages, you're going to start to see bad outcomes. And in fact, they are seeing some hospitalizations in the UK right now. They have reported that.
Hey, Doctor, to the extent that children are having the opportunity to even get the vaccine, most are only taking the first 2 shots. When you look at some of the data, even out of Israel, that seemed quite positive from Pfizer, it really did require a 3rd shot to have any kind of real meaningful push against the disease. What do you do about that? Would you be moving up the timeline for people to get a booster?
Well, the UK certainly did that. They moved up the timeline and said people can get a booster within 3 months. So they're not waiting to see some decline in immune protection in order to make people eligible for boosters. With kids, it does appear that the kids get a pretty robust immune response, better than us adults, to the vaccine. And in fact, the data on protection at 6 months with the children was 100% for 12 and above with a 30 microgram dose. So the children do seem to be getting a more robust immune response from the vaccine. So I wouldn't necessarily think that the experience with adults where you see the waning of immune protection over time is transferable to kids. You might see the same thing, but it doesn't appear to be nearly as sharp as what you're seeing in adults.
And then, Doctor, in terms of behavior changes or not, given what we're seeing in the UK, If you spend time in the Northeast, or frankly, most parts of the country right now, restaurants indoors, they're full, they're packed. People are behaving in large part as if there is no virus. Do you change that behavior?
Well, the question is, can you change that behavior? And I think the answer is no. And public health officials and political leaders are going to try to have to work within the confines of what the public's willing to do. We're now in the third year of this pandemic. People who are excessively worried about it have probably been vaccinated 3 times. A lot of children are vaccinated now. There's a lot of people who are never worried about COVID. Most of them have had COVID, and they think that they're protected because of their prior infection. I don't think we're going to be able to get the public to implement the kind of mitigation that we did during the last waves. And so we're going to have to look for less intrusive ways to get collective action from the public. Masks remain something that's useful when the virus becomes locally epidemic. I think you could still get the public to agree to wear masks in public places and confined spaces. But in terms of closing down businesses and doing things like that, closing schools, it's just not going to happen unless we start to see.
Are you changing your own behavior at all? Are you going to a packed restaurant today that you might have gone to a month ago?
I never went to. Well, I never went to a packed restaurant, but look, I haven't changed my behavior for Omicron, but I've probably exercised a higher level of caution than a lot of individuals, but I haven't changed my behavior for Omicron. I will say I feel a little bit more confident now than I did 6 months ago, 5 months ago, because my children are vaccinated now. My big concern was bringing the infection back into my home. So that has changed my psychology around this, but my behavior hasn't changed for Omicron. It might, if this starts to spread and it's highly contagious and we don't know how it's going to behave in children, I might exercise some more caution. But in terms of going into packed restaurants, I haven't done that in a long time.
Dr. Gottlieb, I think Joe was getting at something that maybe we didn't clarify quite enough. A lot of us are thinking of going over to Europe or have plans to do it next month. And I think the concern becomes not just for us, but for anybody who's planning, let's say, business travel. I feel more comfortable too. My kids are finally vaccinated and I feel great about that. But the question becomes, if you go overseas, let's say to Switzerland, you go somewhere and you pick it up, are you going to be trapped there for 12 days quarantining and not able to come back? And that's another behavioral question for people who are thinking about business trips doing these things. It's one thing to go for their planned business trip, another thing to add another couple weeks onto it.
Right. That's the risk of traveling overseas right now. When people ask me if I'm traveling overseas, my answer is no. And the reason that I'm not traveling overseas isn't necessarily I think the risk there is any higher than it is here, but I don't want to get stuck in a policy change or a quarantine in another country. And, heaven forbid you get COVID in another country and they're going to put you in a hotel and lock away the key. I just don't want to take that risk unless I really, really have to. I think in terms of the risk of bringing back the infection, look, you're going to have to get tested before you get back on a plane, assuming that's negative. I think what people can do is serially test with these antigen tests just to make sure that they're not incubating an infection. And that's typically what I do if I think that I've been in a setting where I could have been exposed. I'll serially test to make sure that I don't, turn positive. So I think that there are ways to protect yourself coming back into the U.S. and reintroducing yourself into your family. I think the big concern would be getting caught in a policy change or a quarantine if you happen to test negative. And, you're going to be subject to another country's PCR machine. You can also get a false positive on those as well.
Way to boost our confidence. Scott, thank you. It's always great to see you, and we appreciate you taking every and all question from us. We'll talk to you soon.
Thanks a lot.
When we come back, veteran internet analyst Mark Mahaney on the companies most likely to profit from the metaverse. Stay tuned. We'll be right back.
Welcome back to Squawk Box. This morning, the internet has now grown by leaps and bounds since inception and is now reshaping itself yet again. Some are calling the next version Web 3.0. One major development in the new web is, well, it's called the metaverse. And joining us right now to discuss the companies at the helm, Mark Mahaney, Senior Managing Director and Head of Internet Research at Evercore ISI. Mark, it's great to see you. Mark Zuckerberg suggests the metaverse, Microsoft too, suggests the metaverse is the future. Still may be 5-10 years off. I don't know what your timeline is, but let's talk about, to the extent investors want to start to think about how to invest in it.
Well, two things that Zuckerberg has said, and if anybody wants to really dive into this, you can watch the Facebook Connect conference of about a month ago, where he spent an hour and a half talking through the different applications that they see rising in the metaverse. But Zuckerberg has at least done two things correct so far on this. He said it is 5 to 10 years out. And it's going to be very expensive. Facebook investors know that. They've been told about the $10 billion price tag for the metaverse this year that's likely to go up. There's a series of potential winners here if it really does emerge. I'm a little skeptical it's going to be as big as the emergence of the mobile internet. I'm a little skeptical of that. But if it does emerge, and there really is much broader than just virtual reality, but if there's a broad use of virtual reality tools and applications, you could see winners in the software, the infrastructure stack, and at the applications level, by the way, just like we saw when the desktop internet rolled out and then when the mobile internet rolled out. I think Facebook would be one of those winners, but there's a lot of other plays in here.
Mark, can you do something definitionally for the audience, which is, and I think they're different, but maybe you think they're the same. There's Web 3.0 on one end and Metaverse. Now, Metaverse may be part of Web 3.0, but I don't think they're the same things.
I have found these concepts a little bit confusing too, Andrew. So I think when people talk about the metaverse, I think in many ways there should be more to this than just virtual reality, but I think that's a large part of it. So let's get down to the apps. This is what really is going to drive all this. The question is whether we will use virtual reality type devices for interactions, work collaboration, social collaboration, if it's going to be a virtual social network, for things like training. And there are plenty of interesting examples already in the marketplace. I mean, there are what I call meta shoots, if you will, green shoots, meta shoots. So I'll throw out a couple of them. Roblox has got 50 million people now on a daily basis interacting with their system. The question is whether all these become interoperable or not. There's a company called Striver that creates these virtual reality headsets that Walmart's using for for 1 million of their associates for training in managing customer service and managing crowds. And then Facebook has sold 10 million of this Oculus Quest 2 devices. One of the major big unlocks, however, may well be if Apple really does develop a virtual reality headset and rolls it out next year. They're pretty good at devices, and you need somebody to really unlock mass market appeal, and Apple could do that.
Mark, are you expecting, I see you're wearing a pair of glasses right there. Are you expecting Apple to do it and to do it in a way that works for the quote metaverse? The reason I ask is there's, I think, a lot of speculation around this being more of an AR, augmented reality style headset, if you will, something that you could actually see through, but maybe adds graphics and other text and other things into the glasses while you walk around and see, but you can see the world, as opposed to a VR experience where you're effectively closed off from the world, but you're living in this metaverse.
So I don't know that they have to be mutually incompatible. I think you're going to see both of these rise in the space that I look at, which is really kind of consumer internet. Snap and Evan Spiegel make a very strong argument for why the world's going AR, not VR. There are kind of limits to how much people want to really be in presence virtually. Zuckerberg is much more on the aggressive VR side. He thinks that people will want to do that. He's going to try to create a lot of use cases to help people do that. So I don't know, but the device is going to be one of the key unlocks. Andrew, you're right. If it's not the clunky headset, if it's entering VR and AR is as simple as taking on and putting on a pair of glasses, boy, that could unlock a series of use cases. But that has to be Oculus Quest 5, which is version 5, which I don't know is 5 years, 7 years down the road. If the devices get better and better, I mean, the apps that are on the Quest 2 right now, I think are really stunning. But there's only 10 million of us who like that. You need to get to 100 million to really prove that there's mass market appeal. And by the way, last thing, you got to make sure these systems are interoperable. If Roblox is creating its own metaverse and Facebook its own and Apple its own, it's not going to work. You need these things to be interoperable.
Mark, I want to thank you, as always, for living in the Squawkverse. We appreciate it. Joe?
Thanks, Can I say, Andrew? Davos in the metaverse? Do you know? That's a possibility, Becky. What do you think about that? I'd be glad to send
The metaverse sounds pretty enticing, right?
I'd be glad to send my
your avatar.
Yeah, my avatar, my quadruple boosted avatar over there. I think he'd be all right.
I have to say, honestly, I'm not as concerned about getting it at this point. I feel like I'd be okay and protected, and most of the people around me would be. It's the question of getting locked down.
You know what I just fired off to the people that know what's going on. You ask that hotel whether they have Netflix, damn it. Because if they don't have Netflix, I'm not getting stuck there for 12 days. I don't know what might happen.
Hey, Joe.
Yeah.
They have Wi-Fi. They have Wi-Fi, my friends. That gets... Good morning. It is the beginning of a big week for investors and the Federal Reserve. Central bank members meeting. They're starting tomorrow, and markets are getting ready for a more hawkish tone. Why the expected change? Well, inflation and plenty of it after Friday's sizzling hot print. We're going to talk about whether it still makes sense for Congress to pass President Biden's nearly $2 trillion Build Back Better plan. And speaking of trillions, Apple closing in on a $3 trillion market cap milestone. We're going to speak with a top analyst on how the tech giant got here and where it goes next. The final hour of Squawk Box begins right now.
Good morning and welcome to Squawk Box here on CNBC. 2 hours, what is it, 15 a week. Just trying to figure out where we are in terms of the week. We are live from the NASDAQ market site.
Less than 10%
in Times Square. I'm Joe Kernan, along with Becky Quick and Andrew Ross Sorkin, U.S. Equity Futures. this hour. Is that right? Yeah, get work
more
on
than
that
10%.
for me while I'm reading these boards. Up not just 8 points of upward movement here pre-market on the Dow. NASDAQ is backed off a little. It was up 60 plus, more than that actually earlier. Now it's up 58, and the S&P up 8 and change. Treasuries, the 10-year, if that's what you like to follow, 1.47 last time we checked, 1.463. It's the latest reading.
We made it through Monday. Once you're up and you're here, you cross Monday off the list.
I'm telling you,
there you
you're
go.
right. Yeah.
Let's get you caught up on some of the other stories investors are going to be talking about today. Check out shares of Pfizer and its COVID vaccine partner BioNTech. A new Israeli study showed a booster shot of their vaccine provided strong protection against severe illness from the Omicron variant. Separately, we got news a short time ago that Pfizer is buying drug maker Arena Pharmaceuticals for $100 a share in cash. Overall, that equals about $6.7 billion. Shares of both those companies up today. Pfizer up by about 1.33%. Arena shares up more than 90%. And then take a look at Harley-Davidson shares. They've been surging in the pre-market. The company announced that it's merging its Livewire electric bike unit with a special purpose acquisition company. Livewire will have an enterprise value of about $1.8 billion and will trade on the NYSE under the ticker LVW. And Peloton shares rebounding a bit this morning after falling 7% over the last 3 trading sessions. Here's a spoiler alert for you. Peloton released an ad featuring actor Chris Noth promoting the value of the company's equipment after his character died in the Sex and the City reboot as he was riding a Peloton, or just after he got off a Peloton. That was a big shock last week. Peloton knew that it was going to have product placement there, didn't realize what they were doing with it, and I think the company was caught off guard. They got saved by Ryan Reynolds. That stock right now up by about 3%. Andrew?
It's an amazing ad. Ryan Reynolds, just a genius. And it was smart of Peloton to lean into the whole situation. I don't think the stock, by the way, necessarily moved on the ad or on the Sex and the City last week and now moving back because of the ad. But I know a lot of people have been focused on the stock. Meantime, our top stock story to talk about this morning, Apple getting very close now to becoming the first member of the $3 trillion club cap market. And Josh Lipton joins us with for more now. What do you think? $3 trillion. $3 trillion could be something.
So, Andrew, let's put this in some perspective. When Tim Cook became CEO back in August 2011, this company's market cap at that point was about $350 billion. Now, fast forward, and Apple's approaching a remarkable milestone here. It's about to reach $3 trillion in market value. Apple has become the world's most valuable business with a strong portfolio of products. And Morgan Stanley's Katie Huberty, who recently raised her price target to $200, reminds us that it is not just the iPhone. Wearables and accessories, including the watch and AirPods, now a $38 billion business. Services, including the App Store, music, video, and payments, now a nearly $70 billion annual revenue business, doubling over the last 4 years. And there's, of course, a lot of hot talk about what could be coming next. Gene Munster of Loop Ventures thinks a mixed reality headset is on the way. Technology allowing users to immerse themselves in virtual worlds while also interacting with digital data generated by sensors. Munster bets that new product is unveiled next summer and launches in 2023. By the way, Munster just raising his price target to $250. Andrew, back to you.
So what do you think? How many years to get to $4 trillion?
You know, I'm not sure, Andrew, our audience, traders and investors, are thinking about how to get to $4 trillion. To be honest, you know, I think the focus for our audience is really going to stick to, at least in the near to intermediate term. And I saw you guys promo Tony Sacconaghi, so I'm interested to get his point here. For our audience, it's really about the iPhone 13 cycle, right? And how that plays out. There are some who have staked their ground. They sit on the sidelines. They say, listen, the iPhone 12 was strong, but that pulled forward demand, and the iPhone 13 just isn't going to have that kind of momentum. I know others think Apple is going to work through these supply chain issues and the demand is going to be there. They're simply counting on the fact that there are millions and millions of people all around the world still on those older iPhone devices, older meaning 3+ years, and maybe we'll have a better sense when Apple next reports earnings.
Okay, Josh, thank you. Appreciate it. And as you said and promoted so well, Tony Sacconaghi is going to be with us in just a little bit. Joe?
Thanks, Andrew. The latest read on the consumer price index showing a 6.8% gain in November. That's a year-over-year basis. Our guest this hour, sounding the alarm over inflation and Democrats' efforts to pass President Biden's Build Back Better plan. Join us now, Republican Senator Rick Scott of Florida. And you walk those hallowed halls, Senator, so you must pass Senator Manchin from time to time. Do you feel that you have some insight into how this is going to play out this week and between now and the end of the year? What do you see? Because the House version is not going to pass muster, we know, on a couple of things for Senator Manchin. So what do you think really is going to happen? Some things will come out in the Senate plan. What do you think that will be? And then what goes back to the House, and will that be palatable to the more left-leaning members of the House? What's going to happen?
You know, I'm hopeful that when every senator looks and talks to their citizens of their state like I do, and they talk to families that can't afford gas or can't afford the food or see all sorts of prices go up and empty shelves, they're going to say to themselves, we've got to stop what we're doing because what the Democrats are doing is not working. Inflation's up. It seems like every manufacturer I talk to are seeing double-digit price increases. It's impacting poor families. So I hope that that every senator says, hey, you know, we can't do this. It hurts our poor families. Then you look at what the CBO put out on Friday. I mean, this is going to increase our debt by $3 trillion. $3 trillion. That's not insignificant. So I hope the Joe Manchin and others say to themselves, we've got to put this on hold. We've got to get control of inflation. We got to quit hurting poor families. That's exactly what this is doing.
Well, Senator, Manchin is not going to switch parties. You know, you see that bandied about once in a while, and he says that's not true. So, I mean, he caucuses with the Democrats. He's going to come around in some fashion. I'm wondering what you think that looks like. And you don't look for anyone else. We had Senator Mark Warner on last week, and I asked him about the actual costs and programs, and he was fully willing to say, I'm looking at the CBO, and I will accept what, you know, that gives him cover. I'll look at what the CBO says. Even though it's GIGO, you give them, you know, these numbers are just going to, you know, the other side's just going to be the numbers you gave them when they come out. But that didn't matter to him, one iota. So, you know, there's only one or two people standing on that side that are throwing a wrench in the works. Tester's not going to, Warner's not going to. And Manchin, he better have some broad shoulders. He's not going to be able to withstand this pressure.
Well, I sure hope so. I mean, I hope he can, because it's not good for families. And by the way, given you know what, $600 billion of tax cuts to rich people in California and New York and other states like that, and cutting Medicaid for poor families in Florida, that's exactly what that bill is doing. It's doing it. It's cutting Medicaid for charity hospitals in a bunch of states and giving tax cuts to the rich. I mean, you can't be doing this stuff. This is not the way this ought to work. But my biggest concern is this unbelievable inflation and this unbelievable debt. There's a day of reckoning in all of this debt.
So you think that like Kevin Warsh, I don't know if you saw that piece, but you don't think it's transitory supply chain issues that resulting from some of the ports, some of the supply chain issues over where in Southeast Asia and elsewhere, the ports in Los Angeles. That's adding to all of it. That has nothing to do with Congress or the Fed.
Paying people not to work. That's what our government has done. You know, just create programs that have no accountability. That you don't. I mean, we're telling people you don't have to work or look for work, and we're gonna. You know, you can be dependent on your fellow citizens. That doesn't work. And by the way, if this was solvable, why didn't the Secretary of Transportation get on a plane, go out to Port of Long Beach and solve it? I don't get what this administration is doing. They don't worry about the border. They don't worry about inflation. They don't worry about the supply chain. It's just like, what are you working on? Tell me something you're trying to get done. Nothing's happening right now with this administration.
Senator, in terms of vaccine mandates, you talk constitutionality. With the two sides are so split, and I think a lot of the poll numbers we see are split. We can't even agree on whether whether employers can mandate, much less a full-fledged mandate for everyone from the government. We know that even vaccinated people can give COVID to somebody else. You can be a carrier. You're still shedding some virus. So once again, we're left with you eventually get to someone who's unvaccinated who can have a really bad outcome. Why is that? Why does personal freedom take precedence over getting that person into a position where he's not going to be in a hospital taking a bed from someone who needs surgery for cancer or a heart attack or whatever? Why not make it induce it to a greater extent so we get to 90, 95, 100% vaccinated?
First off, I believe government's role is to give us information. I don't believe government's role is to tell us how to lead our lives. I went through this when I was governor. I had Zika, which impacted newborns. So what I did is I told everybody where the transmission was, and so they could make a choice whether they're going there or not. I made sure every pregnant woman in Florida had the right to a free test for Zika, and that's how I dealt with it. I had hurricanes. I didn't mandate people evacuate. People evacuated because they were smart. Americans are smart. Give them good information. They'll make a good informed decision.
So at this point, you're staunchly against President Biden's plan to force private companies or to get private companies to enforce mandates. You're totally against that.
If a private company wants to do it, that's their choice. Okay. Government should not be mandating this. And by the way, I did a unanimous consent on the Senate floor, and the Democrats blocked, saying, Biden can't require you to get a vaccine before you live in public housing or food stamps or things like that. But it's okay for businesses. We shouldn't be doing it for anybody. We should give people good information is what we ought to be doing.
You think at this point, Governor, that inflation is out of the bag, and that was the thrust of the Kevin Warsh piece, is that the Fed at this point is in a position where it's going to be very difficult to extricate itself from all the extraordinary measures that we've seen, and that the only way is probably the currency. We need to keep printing, and that will continue to cause inflation, which hurts the people the most. The people who have done well with the Fed staying at zero have been the people who own assets. So now the people that are going to get hurt are the people that are going to get their wages. Any wage gains are going to be evaporated.
They're not saying that. Wages are not staying with this inflation. Number one, the Democrats' reckless spending has caused inflation. Number two, what Jay Powell has been doing by buying up the treasuries, buying up the government-backed bonds, by running up the money supply, those two things have caused this inflation. Are they changing? I mean, look, the Democrats haven't blinked. They want to spend more money. They don't care about, we're at almost $30 trillion for the debt. And by the way, I don't know how in the world anybody feels comfortable buying a long-term treasury right now when who is voting to raise their taxes to pay off this $30 trillion worth of debt. With the Democrats' plan, it'll take it to $45 trillion worth of debt. It makes no sense. You got to change. Live within our means. That's what we have to do today, not in a month. We need to start right now. Live within our means. You have to do it. Families have to do it. Government should be doing it.
Senator, I have a question for you, just because I'm reading up on Hurricane Irma, and it appears, unless I'm wrong, that you were ordering people to evacuate during that period. You actually issued evacuation orders.
No, what we did was I went around the state. I said, here's what we know today. We opened up 7 relief centers, 7 centers where people could go to. We made sure we never ran out of fuel. We worked with the tankers. We worked with the gas stations. We worked with everybody to make sure we didn't run out of fuel. We kept the state open, but 6 million people evacuated.
And you didn't support the evacuation order? I mean, there's many evacuation orders that took place during that period. There was a state telling people that they had to leave.
Yeah, what we did was we gave people good information. I never did an evacuation. I don't believe in evacuation orders. I believe you'll make a good decision. And that's what people did. Over 6 million people evacuated their homes. We opened up relief centers all across the state. And if you remember, Irma went from, we thought first on the East Coast and then ended up hitting the West Coast just south of Naples, and then came up the middle of the state. But we never ran out of gas. We never ran out of food. We never ran out of water because we worked hard every day and we got everybody to work together. That's exactly what we ought to be doing at the federal level now to deal with supply chain crisis. But what I watch the Biden administration is sit on their hands in D.C. and going on CNN. And that's it.
Senator Scott, Thank you. I like that backdrop. I like the Christmas tree earlier, but there's room for all these beautiful backdrops. I'm a little bit envious, but good to see you. Thanks.
When we come back, we're going to get ready for a critical Fed meeting this week. Allianz advisor Mohamed El-Erian will join us. And later today on Closing Bell, don't miss an exclusive interview with Morgan Stanley CEO James Gorman. The Fed and markets definitely in focus. Stay tuned. You're watching Squawk Box, and this is CNBC.
Welcome back to Squawk Box. Dozens killed in multiple states in Friday's tornado outbreak across the Midwest and the South. Now insurers are scrambling to begin identifying customers who need the most urgent response. Contessa Brewer joins us with more. Good morning to you, Contessa.
Andrew, good morning to you. Kentucky Farm Bureau Insurance is the leading provider for commercial insurance and just behind State Farm in residential in Kentucky. And it told me in hard-hit Mayfield, quote, "We don't have a solid grip on the numbers, but have an established presence on site to begin the process of picking up the pieces one policyholder at a time." And Allstate told me it's moving its team to customers as quickly as possible to help with recovery. But it's clear the big hurdles for the economy right now, labor shortages and inflation, will be big challenges for the recovery from this incredible tornado outbreak. The Association for Property and Casualty Insurers says inflationary pressure and supply chain imbalances are escalating by the day, resulting in rising prices for consumer goods and services and increasing claims costs. A recent analysis following Hurricane Ida indicated overall reconstruction costs in September rose 30% over the last year. And we could break U.S. records for natural disaster costs this year. You've got the Texas deep freeze, the damage from Hurricane Ida and its remnants. That combined for nearly $50 billion. And then you have the Western wildfires and now tornadoes. The CEOs of both Chubb and AIG are ringing alarm bells over the risks of increasing frequency and severity of these climate-related disasters. Andrew?
So it's the real question is how are insurers going to think about, you think, premiums in the future for things like this?
Well, what we've seen is that premiums are skyrocketing in places where there is risk. What they've done is they've gone in, they've redrawn the lines. In California, for instance, where state regulators have kept the insurers from hiking up rates too rapidly over wildfire coverage, the insurers have just washed their hands of it and left the state. They say they can't charge enough in premiums to cover the risks for paying it out. So now you've got sort of this public amalgamation of wildfire coverage, and people are still paying through the nose for it, but they continue to rebuild in these wildfire-prone areas. What you're also going to see is, and we've seen it with cyber, for instance, but they're going to start demanding that homeowners and businesses mitigate some of the risks, that you have co-insurance kicking in, that your deductibles are going to be far higher, and then the cap for your coverage is going to be lower than it was previously, so that they can make sure that they have the pool to go in and cover all of these claims.
Contessa Brewer, thank you for covering it all. Appreciate it.
Sure.
Joe?
Coming up, more of this morning's top corporate stories and a feather in the cap for a new player in the EV industry. We're also keeping an eye on Apple's market cap. It's getting closer and closer to $3 trillion. We'll talk more about this later this hour. Stay tuned. You're watching Squawk Box on CNBC.
Welcome back to Squawk Box this morning. Times Person of the Year is, drum roll please, Elon Musk, Tesla's CEO and SpaceX founder and the richest man in the world, appearing on the cover. The magazine out with just that news minutes ago. Writing of Musk's Twitter habit, Times says, quote, with a flick of his finger, the stock market soars or swoons. Also noting that, quote, an army of devotees hangs on his every utterance. Tesla shareholders have been pretty happy with him this year. That stock is up nearly 45% since January 1st. The company's market cap stands just north of $1 trillion, Becky.
Thanks, Andrew. A big recognition for another electric vehicle company, not Tesla. Phil LeBeau joins us right now with more on that. Phil, good morning.
Good morning, Becky. We're talking about Motor Trend's Truck of the Year award. It was announced earlier this morning, and Rivian is the winner for its R1T electric pickup truck. This is the first vehicle from Rivian, so this makes two companies in 2 months. You had Lucid last month, now Rivian, where the very first vehicle from that company is awarded a Vehicle of the Year from Motor Trend. Deliveries of the R1T began this fall, and Motor Trend's editor believes there are enough unique features and capabilities with this truck that should make it stand out.
There's never been a production electric vehicle with 4 motors, and those 4 motors really allow the R1T to do amazing things both on-road and off-road. Of course, it is also one of the most efficient vehicles you can buy on the road today. It gets 314 miles of all-electric range.
As I mentioned, the R1T delivery started this fall. We'll get an update in terms of where things stand with both deliveries as well as reservations Thursday afternoon. That's when Rivian reports its complete Q3 results. We got preliminary results when the IPO happened. The numbers are not going to change dramatically, but it'll be interesting to see what RJ Scaringe, the CEO, has to say during the conference call after those numbers come out on Thursday afternoon. Also, take a look at shares of Lucid, and we're showing you Lucid going back to when the company had its Lucid Air sedan named Vehicle of the Year. Remember that? There was a huge pop in the stock, surged close to $55, $60 a share. It has come back dramatically since then. So what you have seen in the last month is, yes, there may be a pop after Motor Trend names a Vehicle of the Year, but things may change a month later. And finally, take a look at shares of General Motors. We're showing you this because the Hummer EV SUT, it was beaten out by the R1T for Truck of the Year. First deliveries are going to be happening this month. So there's a lot happening in the EV space, guys. But for Rivian, this is a nice feather in their cap, and also one that's going to generate even greater interest. People do pay attention to things like Car of the Year and Truck of the Year.
Phil, thank you. Coming up, we're going to have much more on this week's key Federal Reserve meeting. Could the central bank have to go further than investors currently think if inflation stays hot? We're going to talk about that with Allianz advisor Mohamed El-Arian. Stay tuned. You're watching Squawk Box, and this is CNBC.
Welcome back to Squawk Box this morning. With the inflation surge, both bond and equity markets have started to price in a more hawkish Fed. But the question is, are investors still behind the curve? CNBC's senior economics reporter Steve Leisman joins us now with more. Steve.
Morning, Andrew. Yeah, another strong inflation report Friday with promises of more to come. It does raise the question whether the Fed may have to do much more to get control of rising prices, not just taper faster or even raise rates earlier. Markets already have that priced in, but actually move to slow the economy. Here's a preview of tomorrow's Fed survey. We asked if the Fed eventually could have to raise rates above neutral and slow the economy. 45% of respondents say yes, 48% say no. So it's an issue that's out there. Rapid changes in the Fed's own policy outlook mean that most forecasters only now catching up to where the market's priced. They have brought forward their estimate of the first rate hike into the spring or early summer. But is that enough given the current inflation outlook? JP Morgan's Mike Ferroli writing over the weekend, while market pricing incorporates an early Fed start, it's not anticipating the cumulative adjustment that lies ahead. We forecast policy rates to rise 175 basis points by the end of 2023 and see Fed forecast projecting a return to a neutral stance, 2.5% in 2024. Fed futures market is priced in a May rate hike, just about a second hike in September, and a third one coming in December. That would put the funds rate just about 88 basis points at the end of next year. Investors, they're going to watch the Fed's own new projections. They're going to come out on Wednesday to see how aggressively the Fed itself forecasts the path for the funds rate. The real Fed funds rate, take out inflation, minus 6.8%. That's the lowest on record, lower than it was under Volcker. The Fed has a lot of work to do to get to neutral. Question is whether markets have priced in that level of tightening, Andrew.
Steve, stay exactly where you are because I want you to be part of this conversation. Joining us right now is Allianz and Gramercy advisor Mohamed Al-Arian. He's also, of course, the president of Queens College, Cambridge. Good morning to you. Why don't you try to answer the question, if you could, that Steve just raised, which is effectively, do investors have it right or not at the moment?
So I think the fixed income part of the investment universe has it pretty right. Has it right not only in terms of pricing the rate increases, but also recognizing that there's a limit to how far the Fed could go. This economy cannot support higher rates quickly. The equity market is playing the liquidity paradigm, and they are right to do so. Even under Steve's scenario and under the market scenario, we have another 150 to 200 billion of liquidity injections ahead of us in the next few months. So I think there is this massive difference between the two markets, and it makes total sense.
Mohamed, I don't know if you heard, Steve and I were talking a little bit earlier about Kevin Warsh's piece in the Wall Street Journal this morning, and we don't need to relitigate whether it's all the Fed's fault, which is in large part of the thesis. But if you try to look forward in terms of how you think the Fed is going to think about this, not just how they will think about it, but how they should think about it in terms of dealing with the stability of the financial system and the monetary system, how do you think they should do it?
So the way they should do it is recognize that they've been caught massively offsides, that they are late, that their inflation read was awful, and they have a credibility issue. And the reason why they got caught massively offside is they were functioning as if the problem is deficient aggregate demand. And it turns out that the problem is not on the demand side, it's on the supply side. So they are caught with the wrong paradigm. So that's reality. If I were them, I would do three things, which they will not do. I would, one, be very open and honest as to why I got the inflation call wrong and try to regain the inflation narrative. Two, I would go even further than doubling the rate of taper. And three, I would open it up to the possibility that rate hikes may come faster than what the market has. They're not going to do that. What they're going to do is double the rate of taper, not go beyond that. They're going to tell us that inflation is more persistent and higher. We know that. And then they're going to wrap all that up in the uncertainty packaging because of Omicron. Right. So they're going to stay behind and fall further behind, in fact.
Hey, Steve, is Jay Powell saying to himself, I got it wrong? Or is there somebody else on the board who's saying, hey, Jay, we didn't get this right?
Jay Powell basically said publicly he got it wrong. I mean, what do you make of that speech he made at the end of November where he said it's not transitory anymore? We're gonna taper early. Remember, the Fed made a decision beginning of November to do 15. He came back at the end of November, said we're doing 30. I'm not sure what else Fed Chair Powell has to do to say that he got that wrong or the Fed got it wrong. And why did he say that? Well, he said, among other things, we maybe need to get around to thinking about hiking rates sooner. So, yeah, they got that wrong. And they also got wrong the extent to which I think supply constraints were an issue, that it was, as Mohammed said, a supply side issue rather than a demand side issue. They were treating one problem and it was another. I want to get back to something Mohammed said, which is really interesting, which is playing the liquidity game for stock investors. And Mohammed can correct me if I put words in his mouth the wrong way, but there's two aspects to this. The first one is that the Fed is going to continue to buy for quite a while. That's one thing. That's what they call the flow argument. There's another argument called the stock argument, which is that the Fed's balance sheet has cranked up over the time that we've been hanging out here and talking about this from $4 to $9 trillion. Over the course of the next year at least, the Fed's balance sheet is going to remain $9 trillion. We ask a question, I'll bring you the answers tomorrow, about whether the Fed eventually is going to get to balance sheet reduction, but that's down the road. So for at least some foreseeable future here, we have inflows into the stock of how much the Fed has, and we have a huge stock of $9 trillion. All of that, I think, sets up a pretty decent environment for stocks until or if it gets spooked by the idea that the Fed may have to clamp down on the economy in order to get control of inflation.
Mohammed, you agree with that?
So certainly on the flow side, remember, there's nothing more reassuring to an investor than knowing that you have the Fed buying, because the Fed is a non-commercial buyer. And if the Fed is price insensitive, it makes everybody else price insensitive. So I completely agree with Steve on the flow argument. The stock argument, I don't know. We haven't been there before. I don't know what happens on the stock. He's absolutely right. The stock isn't going to come down anytime soon. So you're not going to have QT, quantitative tightening. But I'm not quite sure how the stock side is going to interplay with the interest rate side. But he certainly is right on the flow side.
Hey, Mohammed, on the stock side, we've got Apple up on the screen. As you know, it's about to hit a milestone, I think, of about $3 trillion. Is there something to be said about that in terms of where we are in the cycle?
I mean, it's the everything rally again. We are at record levels. And I'm not surprised. You know, I've been the time telling you, don't underestimate how confident people are pushing this market higher as long as the Fed is behind us. So the Fed put is going to be in effect until the Fed stops buying. That's going to be the big test. Not now, but when it stops buying.
Mohammed, I'm just wondering, you have this minus 6.8 funds rate, which is take the funds rate of 0, lop off inflation. I mean, it's unbelievably low. In fact, the Fed has gotten easier since inflation's gotten higher. Does that put more of a premium on stocks in that you're looking for return? You not only can't get it in the fixed income market, but you lose more money than you were losing before in the fixed income market on an inflation adjusted basis.
Yeah, and you don't want to be in cash when inflation is at 6.8%. So in the relative paradigm that we're in, equities shine. The question is, we start at minus 6.8, as you point out, historically negative level. The Fed is way behind. It is not easing its foot off the accelerator quickly enough. It is still stimulating this economy. Is it going to have to slam on the brakes? The thing that the market cannot absorb is a late Fed that then slams on the brake, because you know what happens then. The risk of recession goes up, and then the marketplace starts worrying about earnings. So that is the big risk, is that by being so late and going so slowly, they may have to hit the brakes. And that's not something that the economy or the marketplace will appreciate.
Hey, Mohammed, we had Barry Knapp on earlier, and he brought up a pretty good point. He said, rather than just tapering, where you slow the pace of buying or maybe even stop the pace of buying, why don't they do something like shrink the balance sheet before you start raising rates? Because that could be pretty targeted. It could hit some areas that you really do want to see a slowdown in some of the hot numbers, like housing. You know, if you shrink the number of mortgage-backed securities that you own, maybe that's a more effective tool and one that might be less damaging to the overall economy. Plus, you get rates up at the long end.
They certainly should think about it and analyze it. I don't think they're going to go there. I think this Fed is somehow caught in a cognitive trap whereby it stayed in transitory way too long. It kept on repeating this, even though the data suggested otherwise. Now it's caught into the sequence that was defined a long time ago for conditions that don't exist today. And I don't see them getting out of that cognitive trap. So I agree with him. We should certainly look into this, but I don't think that the Fed is going to go anywhere near this. They're going to do first stop buying, then they're going to do rates, and down the road they'll think about reducing the balance sheet.
Ahmed Alarian, Steve Weissman, thank you both breaking it all down for us. Appreciate it.
Coming up, we've got Jim Cramer's first take on the trading week ahead, and then inside Apple's march to a $3 trillion market cap. Right now, take another look at the real-time level. Bernstein's Tony Sacconaghi is going to be joining us to talk through all of this. That is just about, 80 cents or so from an all-time high, maybe a little less than that, from hitting $3 trillion. Stay tuned. You're watching Squawk Box, and this is CNBC.
Down at the New York Stock Exchange, Jim Cramer joins us now. Jim, from what I can glean from some of your musings this morning, you're wondering about the early strength continuing in some of the averages. You pointed out, the Fed said some stuff Wednesday. We've got 100,000 troops on the Ukrainian border. We've got Taiwan, just this most beautiful little tech place, just waiting, for someone to. There are some things to be concerned with. Do you think Putin, he's already factored in sanctions, hasn't he? Do you think he was dissuaded from whatever his plans are?
No, I think he's just a mischief maker that really does want to try to assert what the Russians were like in another era. And I think that I'm trying to figure out how much the market cares. Obviously, the market cares that day, right? The market cares that day, definitely, and cares the second day. But I think the market cares more about Dr. Gottlieb, who the market Dow was up, the futures were up before Dr. Gottlieb came on. Where it was kind of chilling because obviously if this is coming our way,
Travel.
That's more important right now for the markets. Wow.
There's just no way to plan. We all think of ourselves in our own personal situations, but it's a really big decision to decide to head over. I think, if I was going to go on a vacation, maybe Disney World, maybe, if you're going to do it, maybe stay domestic. Would you leave the country, Jim?
No, not right now. Not with this. I've been thinking a lot about it. Obviously, a lot of us want to travel, but when you hear the leader of a country just say, basically, stay away from our country, and that's a country that's pretty good. I mean, what happens if you go to another part of Europe? I wouldn't go to Asia. I mean, I think our country is the best place to go. And I feel like that's a major change from what I would have said even 6 months ago, where I thought it was okay again. So, I mean, I listened to Dr. Gottlieb, who, of course, is on the board of Pfizer, and it just worries me because I really kind of felt better before he spoke.
Well, that was my question. I do feel better. I'm tripled. I'll do.
Yeah, me
I'm
too.
I'm ready for 4, but I'm not. I don't. I love the technology of messenger RNA, and a lot of people do not understand it, Jim. They really don't. They talk about it's like genetic engineering. It's elegant. It's an elegant way to do it. It's just spike proteins. There may be an immune response to spike proteins. Well, there's an immune response to COVID spike proteins too. That's probably 10 times
you talk
worse.
about T cell. Nobody else talks about T cell.
Right.
T cells is the win here.
So I feel
and
good.
I feel like it's just the message has been told wrong.
I don't want to get a mild to moderate case, though, that breaks through because it's Omicron and it doesn't work. I don't care if it is mild to moderate. I don't feel like getting it. I don't feel like quarantining. I don't feel like giving it to someone who could get who's immune compromised or whatever. So we're back to thinking about that.
That's exactly how I feel. And I just, if I were going overseas for my vacation, after listening to Dr. Gottlieb with the idea that it could be a quarantine, could be a problem getting back, I would cancel. And I would cancel. I understood canceling the vacations that people were taking for a safari. But now, I mean, he made me feel like, listen, be really careful with Europe. These get just insurance.
You hear mild to moderate, but then you hear how quickly it's exponentially, spreading. And it's not going to matter if it's, I mean, it does matter that it's mild to moderate, but it's still not something you're willing to say, hey, it's mild to moderate. Bring it on. So anyway, thanks, Jim.
And the older people I know have had breakthrough. It's been pretty tough. Younger people, not as tough.
Well, it depends on
or autoimmune, immune deficiency. Bad.
Yeah, that therapeutic is going to be the pill.
Yes,
the Pfizer pill is going to be the game changer, Jim. Until then, I'm not sure.
Fast enough, right? We just can't get that fast enough.
All right, thanks,
I thought
Jim.
Dr. Borla should have been on the cover of Time, Paul Pancel. That's
Maybe
bad
you're right.
choice, Musk.
Next year, maybe.
Musk.
They're always late.
Evergreen.
They're always late. I liked when I was on the cover. That stupid
That was the
mirror
best
that
issue.
said you are on the cover. It's like,
I mean, when you were covering Sports Illustrated, that was the curse. You never played well after that. It's a mix and got it.
I had a good weekend. I had a good day yesterday. I can't believe it. It's a miracle. I actually won a few.
Good for you.
Anyway, thanks. And we want to remind you about the new CNBC Investing Club. You can sign up to find out more at cnbc.com/investing club, or just point your phone at the code right there on the screen and it'll take you there. Squawk Box will be right back.
It wasn't that long ago that Apple was worth a mere $2 trillion. But over the past year, it's made its way up to almost $3 trillion in market cap. The level to watch today is $182.86 a share. Yeah, not far away, just over 86 cents. Joining us right now to talk about how Apple got here and where it's headed next is Tony Sacconaghi. He is senior research analyst at Bernstein. And Tony, this is just one of those round numbers that we pay attention to. But if you've been watching Apple over the last year, up 30% for this year, and that comes after being up 80% the year before. So this has been a phenomenal rise. With those sorts of gains, how do you come down on this just in terms of the risk reward scenario and how much room is left to run?
Sure. Good morning, Becky. It has been a terrific run for Apple. And look, credit to them. I think they've executed extremely well during the pandemic. They've really driven the services business, and investors are increasingly recognizing Apple as, an extraordinary consumer brand. Now, that said, as we look forward, we have seen the stock go up 25% since October 1st. The stock's trading at about 33 times forward earnings, which is about as high as Apple has ever traded on a multiple. And we've seen, this will now be the third year where we've had a really strong year-end run. We typically haven't seen that persist, particularly ending 2020 and going into 2021. We had a similar phenomenon. The stock had a really nice run up at the end of the year, went to about 32 times earnings. It underperformed somewhat in the first half. So I don't think there's anything, quote, wrong with the Apple franchise, but the stock's had a tremendous run, particularly in the last 3 months. I'm not so sure that necessarily persists in the first 3 or 6 months of 2022.
One of the things that you've been thinking about for the longer term, though, is the stock buyback program. And that's been pretty phenomenal, buying back such a huge amount of shares with the cash they have on hand. You actually think that they could continue this for a very long time to come? I mean, 15 years?
Yeah, it's really incredible. I mean, Apple is a cash generating machine, and it pays a modest dividend, and it doesn't do acquisitions. So it generates a lot of cash that can continue to use to buy back shares. And then ultimately it also has a big cash balance right now, net cash of almost $100 billion. So the combination of those two things, strong free cash flow generation that doesn't have a claim on it, plus a healthy cash balance today, means that Apple can continue to buy back its shares aggressively for the next 5 years. If it chose to take on a modest amount of debt, which its balance sheet could do, it could probably buy back, by our analysis, 2% of its shares, 2 to 3% of its shares per year for 15 more years. And, obviously that's accretive to EPS. So the buyback alone on a sustained basis could add 2 or 3% to EPS growth.
On the other side of the ledger, though, there are concerns about the supply chain for Apple and its tight relationship with China, when the relationship between China and the United States is really fraying at this point. How do you try and do a risk-reward scenario for international relations at this point, which obviously matter?
Yeah, I think it's a great question, Becky. And Apple's exposure to China is almost 20% of its revenues, but obviously much more so in terms of its supply chain and its products being almost entirely assembled in China. So there's really significant geopolitical risk, but it's very difficult to handicap that. I think Tim Cook deserves a lot of credit for the diplomacy that he has exhibited in China. And fortunately, Apple, unlike a lot of other companies, because it's such a large employer in China, that somewhat works to its advantage. It's not only benefiting from China, but it is beneficial to China. And so from that perspective, it may have a little less risk, than other companies, which are really only participating and arguably taking from China. But it's very difficult to handicap what might happen geopolitically. I would just say that Apple is arguably in a slightly more, or not even slightly, in a more advantaged position than other companies, given its employment base there.
Hey, Tony, I know that Apple has some pretty talented managers and people who are really putting a lot of input from different areas in the entire company. We used to talk about Steve Jobs as being the key man, as the founder, and that nobody would ever really be willing to take that role. But I would say the job that Tim Cook has done over the last many years makes him the key man at this point. It's kind of phenomenal to think of a founder handing off to somebody else who you then look at as being indispensable. How do you factor for that?
Yeah, look, I think Tim's done a tremendous job, and part of it has been China, which we just spoke about. But I think the other was really transforming Apple into a services company. That, Tim's belief that Apple has a franchise and a trust with consumers, and that it could leverage its installed base to sell services that they would enjoy and would enhance their experience. That's probably been the coup of what Tim Cook has done. Now, I think to some degree, just given Tim's personality, the leadership is a bit more distributed than it was when Steve was CEO. And so I think that's a good thing. And I think Tim is good about inculcating a culture and skills, perhaps more broadly than Steve was, who was very, very product driven and very creative driven. I would argue that Tim is a more well-rounded manager in that sense. But kudos to him. I do think Apple has a great bench of executives. It's not clear who the heir apparent is. I think Tim's been clear. He's probably not there for a decade, but he's here for a few more years. Yeah. And so there's still time for that to play out.
There certainly is. You can call him the maestro or any other word you can come up with. Tony, thanks for your time. It's great to see you.
Becky, thanks for having me. Have a great day.
Well, guys, that does it. Monday officially off the books for us. We're going to be right back here tomorrow. So, Joe, that's officially 20% down.
That's right.
And
it'll be the 14th tomorrow.
It will. Yeah. Christmas is coming far too fast. We'll see you guys tomorrow. Squawk on the Street starts now.
Good Monday morning and welcome to Squawk on the Street. I'm David Faber. He's Jim Cramer, and we are live from the New York Stock Exchange. Carl has the morning off. Let's give you a look at futures as we get ready to begin the trading week 1/2 hour from now. You can see we are looking for a higher open, I guess it's fair to say. Our roadmap does start with that market rally we've seen lately as the S&P looks set to add to its record close. By the way, if you're taking a look at Apple, you know it is closing in on a $3 trillion market value. Plus, weighing the COVID risks for investors, the UK warning of an Omicron, quote, tidal wave, while a new study shows that Pfizer boosters, they remain effective. And Elon Musk nabs Time's title as 2021's Person of the Year.
Yeah.
All right, let's start on the markets. What do you think as we head into this week?
Well, I think that the market seems to be a little oblivious to Wednesday, to Powell. I was hoping that we would come in today and people would, most of the research would be about, okay, here's the new position we have to have. The Fed tightens. We didn't get that. When I did when I convened the investment club meeting last week, I was hoping that we would get a downturn ahead of it so that if he shocks us, we would already be cushioned. Instead, all the research is, here's my favorite ideas for 2022. And everybody likes everything. There's just this kind of, to me, this stuff is very not in sync with what we're seeing ourselves, which is that high growth technology has been failing. And yet everyone's recommending those today. Mm-hmm. A lot of people recommending all these IPOs, David, that you and I both know are not as substantive as we'd like.
It's been a difficult, if you own IPOs after day one trade or the first trade, you are not happy if you still own them. Now, a lot of that's made up as well of SPACs, not a lot, but certainly a significant amount of IPOs have been SPACs, many of which are trading below 10. But you're right, not been a good year for the performance of initial public offerings.
No, and I sit here and I think, well, wait a second. Are these investment banks really saying that it's time to buy sweet green? I mean, is it really? Is this the moment that you want to buy Braze? I mean, all of these companies, a lot of them do the same thing, David. They've met the art of optimizing customer engagement. Now, customer engagement, I always thought we had that with Salesforce. Didn't we have that with Shopify? I mean, I thought we had that with a half dozen companies that I think have already figured out how to engage consumers. David, these companies I have no interest in these companies. There's too many of them.
Right. Okay. So you're a little, as we head into Wednesday, with the prospect of the Fed being giving us more on the taper.
Has to be tougher, and we know that. Although you'll have like someone like Mohamed El-Arian say it's already too late. I mean, I never buy it's already too late, but he's not going to solve the port dilemma. We had a really good piece this morning.
Already too late, what, to combat inflation? Is that what he's saying?
I mean, inflation's high.
Yes, it is.
Inflation's high.
Yes, it is.
And the supermarkets, it's more expensive. Wages are higher, but it's uneven, not enough to cover, in a lot of cases, the inflation. But the inflation is not necessarily, you'd have to really destroy the economy in order to save it here.
You know, I asked you last week, though, last time we saw an inflation print like that in 82, what were rates? I think they were 13%. 13%.
Yeah, you got a great deal on those treasuries. And that was
when you were at 1.6 only a few weeks ago.
That's a greater return than most stocks.
Oh, my God, yeah.
But I'm more concerned about the David Kostin piece about how long can you have the breadth of 5 stocks being 51% of the performance of the S&P. And I come back and say, well, wait a second. I think that, so what? I mean, you really think that means the others won't catch up?
Well, there they are. Or at least most of that, a lot of that performance. By the way, Microsoft, sometimes we forget as we watch Apple so closely, Jim, Microsoft
Well,
up
that is FANG, except for Microsoft
54% this year, as it surpasses $2.5 trillion in market
every one of
value.
those was down.
Was up and had a very nice Friday. Microsoft did, along, of course, with Apple, which we just mentioned, now up 35% for the year, helping to power the S&P, of which it is the most.
But think about these companies not affected by Omicron or any version, okay? Have tremendous franchises. They keep reinventing themselves. The last one being Apple. I mean, I know a lot of people talk about Apple being $3 trillion, but I look at Apple as what happened 3 weeks ago when we got a report that Apple basically 13 was a dud. I think a lot of hedge funds. Remember all these hedge funds that have to be 20% short?
Barely lasted a day, and of course you were dismissive of that story, and most likely correct in being dismissive.
Although I got heat because I was so vicious about it.
If we hold up with that number there, it'll take us just within very few billion of $3 trillion.
Right.
It is an astounding number. I know we focus on it and then we won't. I can remember when we were sitting here talking about $1 trillion, which seemed hard to imagine, frankly.
But what does it mean? I mean, Elon Musk, trillion. What does it mean? Versus, say, Ford, maybe. Ford's got the Mach 5e, but I don't think it's
Salesforce and Ford within the first 5 minutes of the show.
Well, I just think
glad we're keeping that up.
I'm trying to deal with Time Magazine's cover of the year, but where's Dr. Borla? Where's Bancel? But maybe the Time Magazine people don't think that the vaccines. I mean, they're not anti-vax.
What do you know?
They're not anti-vax.
You have some insight. Your buddy is Benioff. He owns it.
Benioff has said over and over again that he is not going to influence Time, and he clearly didn't because he was favoring the tree as person of the year.
Trees are not people. You got to tell him that, didn't you?
David, you're so small-minded.
Didn't know that.
I don't know. Let's call Mark Zuckerberg.
Secret Life of Trees. What about Zuckerberg?
No, this is a line from Succession. See, this was a weekend where Peloton.
Don't do that. No. I did hear it.
No, okay, Succession.
Succession was amazing.
I mean,
but our executive producer hasn't watched it. He's standing right there. Don't ruin it for him.
Okay, Next Door feature on Saturday Night Live. I mean, David, we're very much in the news. It's just not for anything substantive.
By the way, Succession too. I mean, I'm like I've lived this. I mean, you know what that was equivalent to what they chose to. I can't talk about.
Don't. I mean, you spoil. Oh God, you spoil everything.
I spoiled Big dying on the.
Oh, you spoiled. You wrecked that. I didn't even bother to watch. That's the thing. When you had a spoil like that, that means we don't watch.
Meanwhile, Peloton's using it now to their advantage.
But these are stock market issues.
Okay.
Do you think that they didn't realize they were going to hurt Peloton? You know they did.
I don't know about.
Do you think they were short Peloton?
I don't know.
Well, that was something, huh? You exposed that.
All right. To wrap up your view of the market, which will change, of course, as of who knows.
Just saying, Wednesday.
Yeah.
Look, there's some pieces out which talk about the actual wordage. Now, I know Steve Leisman's into this, but if he drops this word, does that.
Right.
But the overall nature of it is the market's not as good once they start tightening. There's fewer areas.
And you're questioning some of the positive research on these high multiple growth names that have been getting hit lately.
They've been questioned. What are you going to try to resurrect them? I mean, David, this is the time to buy Monday.com. I am telling you. You never want, if you get in HubSpot, but you're not in Qualtrics, I don't know what you're talking about. But stay away from Power School, please. And Kaltura, I'm not sure at all.
Somebody actually wrote those names down?
No, I mean, they're like funny. I mean, like these are like, we're in some alternative universe. None of these companies even exist.
I've never heard of a
You know,
lot
it's
of
really
them.
time to buy, Qualhome.
It always cracks me up when some
Braze.
company we've never heard of gets
Braze.
bought for $10
There's
billion.
6 pieces about Braze today.
Yeah.
Now, Braze, David, is
What
new
does Braze
marketing
do?
tech. Their new marketing tech stack.
What is Braze?
They help you to compete against other people who have Braze.
It's not about like your brisket or anything
No,
like that,
Braze
right?
and Blaze. I mean, I don't know. When's a helicopter company? And David, can we just go back over BuzzFeed?
Really?
Okay, no, I'll go over it. Home builders. I like Toll Brothers. No, I'm just saying that everybody likes everything. Sweet green unit. Here, lettuce. Let us begin. Look at these, David. All these guys are trying to be funny. Sweet greens. Let us begin. And you know what they do? They add plus to everything, or they add forward. Do you know that Sweet Greens it's.
Do they have a streaming service now?
No, it's Lettuce Forward.
Lettuce Plus? Forward. It's going to compete with Disney Plus, Apple Plus.
West Side Story.
How many other pluses am I forgetting?
West Side Story. Minus.
Didn't do well.
We're just covering
Didn't
too
do
many
well.
issues.
Got
Let's
great
be more narrow.
reviews. All right, let's move on to the pandemic, actually, and get back to being
you don't
serious.
have to. We're not going to play Gottlieb, are we?
Yes, we are.
I canceled everything.
Yes, we are.
I have to listen to Gottlieb.
Because a new Israeli study does show that a booster shot from the Pfizer-BioNTech COVID-19 vaccine provided strong protection against severe illness from that Omicron variant. But on the other side of this, the UK Prime Minister Boris Johnson accelerated his country's booster rollout. He also announced the first death in the country from the new variant. UK Health Secretary says the variant is spreading at a phenomenal rate. And the aforementioned Dr. Scott Gottlieb, who we go to often here because he has been often right, he weighed in on the situation in the UK earlier on Squawk Box.
It's deeply concerning to see the British take this stance because they have very good data, they have very good systems in place. And so if they're seeing a very significant threat from Omicron, I think the world should really take notice of that.
Yeah, that was really, I thought it was a major wake-up call. I always listen to him, stop everything, listen. And he's basically saying, remember, if you go away, there could be a quarantine. We may not be able to let you back in.
Right.
Boris Johnson, the UK data is always very strong. They test constantly there because the testing's free. And I think a lot of people who listen to him will cancel going away.
You do. It could have an impact. Yeah,
that was just devastating.
We already canceled going.
I don't know
but because of the hassle of it all.
Right.
What about milder symptoms, which we continue to hear anecdotally, but everybody says you got to wait
until you get the viral? I think people just feel like milder symptoms. Who knows how bad that is? I had thought that
seem that
the
bad.
Holy
If you've
Grail
got
was
3 shots in you, it's
right.
not gonna be
I thought
bad.
that was going to be it, but now I'm saying, David, the clarion call of Dr. Gottlieb was, "Don't go anywhere." Don't
Anywhere?
Go anywhere. What? Maybe in the United States. Go to Disney because the investment club owns Disney. You haven't hit me on that.
Meanwhile, Pfizer's using some of the vaccine money to buy
to do
things.
something.
Yeah, obviously generating a good amount of cash from all those vaccine sales. What, 40 billion? Now they split it with BioNTech, but still at a 50% margin. What, 10 billion or more in cash?
CAR-T, ulcerative,
they buy
everyone.
Arena Pharmaceuticals.
Very crowded.
If you owned it on Friday, it's a double. You'll take that. You'll take it 100%
Well, a lot of
premium.
people like Arena because CAR-T is very good. It's personalized medicine.
It is, and they, as you point out, ulcerative colitis is their main focus. But it's generally on immunoinflammatory diseases. Now they don't have phase 3 data here.
I know they're so early.
I love that it's $100 a share. I don't know why. It's just like no, we won't take $99.99. It's got to be $100.
Oh, really? Dollar Tree?
No,
Dollar Tree Plus?
Yeah, exactly. Now it's $1.25. But Jim, it does take you back to, all right, Pfizer can use some of this.
Well, Pfizer had a big
cash.
patent cliff. This is a huge
And
win
they have
for
the big
Pfizer.
patent cliff coming. They can use some of the cash that's being generated by their vaccine revenue to put them in a position to deal with some of the patent
So then
expirations.
Pfizer does get up, it gets re-rated because they do have all this cash. And by the way,
instead of returning it to shareholders and with a buyback,
like
which
Bristol Myers, which doesn't have anything of new real growth, and myocardium is still waiting.
You know what,
David,
Bristol
I think
Myers-
Pfizer's got another 3 or 4 companies that could buy.
Well, and that, it's funny. We get like one of these a month, but there are some who argue we should be getting more than that because it's not just Pfizer that's dealing with patent expirations. Come 2028, you got Revlimid, you got Eliquis, you got Keytruda, Merck's key drug. I mean, there's a lot of important drugs that generate tens of billions in total revenues that conceivably are going to be off patent or come off patent in 28. And so you want to get started now. because 6 years from now is when they conceivably, many of these drugs, if you get it at the right price,
Well, I went over
and if
the
they succeed, are going to
391
be
companies.
actually.
You should go over the 391 companies that come public there. Half of them, of course, have just been a disaster, but probably a third of these companies are biotech.
Yeah.
And they're orphans now. I mean, not orphan drug, but they're orphans. Nobody wants them. The Chinese stocks and the biotech stocks.
They are until a Pfizer or a Merck
Right,
comes
so
along
you
and pays
can't-
100% premium.
Right. And then you think, wow, what a lottery ticket, huh?
There you actually got to know what you're doing.
But let's pull back for a
Investor.
second. The
Spend some time.
overwhelming notion of the research today is that you don't need to think about the Fed at all. It's going to be a great year. And I just think when I read that, I wanted a little bit more circumspect. That would help because the numbers of stocks that you can really get behind do diminish. But, people don't care. I saw
Why not just
positive
ignore
on the
all
rails,
those? Why
positive
not?
on lumber, positive on home building, positive on Bristol Myers, positive Ford Motor.
Most money
positive.
still is going into ETFs and index funds anyway, and it's all
Yeah,
so
$1 trillion.
it all just gets into.
And then
Everybody buys Apple.
Bernstein likes Famang, Airbnb is I can't brace. I keep coming back to ChargePoint. People suddenly saying it's time to own
You
ChargePoint.
just look at people.
What Amazon.com
waste
is
more.
the one.
You are a tree's nightmare, is what you are.
Well, that's why
I mean,
Benioff
enough
was
with
right
this.
with the tree being the man of the year, person of the year.
You got like 17 pounds of paper.
Well, I have to go through it. Unlike you with your, I don't know, what are you studying? Engine 1 and Exxon? I mean, look at this. I have to go through the Costin outlook. Costin, is he on today? You always have to book Costin, right? Is Costin on?
No, he was on Friday. Was it Friday?
Can't have
or
enough
Thursday?
Costin.
He was on.
You can't have enough Saganegi. Can't have enough Costin. Can't have enough Mark, right? Mahaney. And who else can't you have enough of? There's one other guy.
Dan Ives. Yeah.
How about
Todd's becoming
Dan
like that
Ives?
guy? And
how about a couple of
like
Dans?
the guy who was the guy in Regis who used to stand on the side and scream at them? Gelman.
It's Gelman.
It's our Gelman.
Hey, Gelman, by the way, is incredibly
Don't tell
nice.
Gelman what happened on Succession.
No.
Because somehow he couldn't watch it last night.
No, exactly right. Oh, jeez.
All right, we got a lot more news coming on the EV front coming up. Harley Davidson is taking its electric motorcycle unit public via, a SPAC deal.
Good.
Let's give you a look at futures. Get started with trading 15 minutes from now. Still looking for a higher open, at least when it comes
Coca-Cola
to the
upgraded.
NASDAQ.
You don't even mention Coca-Cola upgraded. General Mills, we're feeling very good about the December 22nd forecast.
Those are two names at least I know. More Squawk on the
I
Street
know, but
straight
that's
ahead.
the way it used to be.
And Peloton close to a 3 handle now, Jim.
Wow. Well, you know, the key area that seems like guy having a heart attack on Peloton. Spoiler
yes,
alert.
it's a spoiler
Alert.
which I don't think the company has addressed.
No.
Maybe they had a statement.
No, I don't know. But look,
yeah, my wife watched that last night. I'm like, really? They killed him off in the first episode?
you're not supposed to. It's a spoiler, David.
I don't care. Wow, I didn't care. But as we mentioned, Peloton is firing back at its portrayal on HBO Max's Sex and the City reboot, which implied that its fitness equipment could lead to health complications. Peloton out with a parody ad, essentially saying, hey, that's just not true.
Should we take another ride? Life's too short not to.
And just like that, the world was reminded that regular cycling stimulates and improves your heart, lungs, and circulation, reducing your risk of cardiovascular diseases. Cycling strengthens your heart muscles, lowers resting pulse, and reduces blood fat levels. He's alive.
I'm actually getting tired of Ryan Reynolds. I watched
everywhere.
Watched 1/3 of that Red Notice. I was like waiting for Aviation Gin to appear. He's become a conglomerate.
Red Notice was horrible.
And I like him.
That's another.
It's,
I'll
Canadian
give my
Mountie thing.
yeah.
But no,
all right.
David. Chris North
This
watches
was-
the show. Chris North is incredibly interested in
Love
business.
him.
We're going to have Chris North come tomorrow.
Great.
I'm going to tell Gelman.
You're going to put him on a Peloton here?
No, I want Chris. Let's call Chris. Chris absolutely loves the stock market.
Okay.
Loves it.
Yep.
And he would be great to have one for his perspective because, David, we've got lots of business stories bleeding into TV and vice versa.
Does he have perspective on whether Peloton's a buy at $39.15?
I think he will. He's actually very interested in stock market. Always has been. We have Zuckerberg in Succession.
He was mentioned.
Well,
Yes.
it doesn't matter. But I'm
A lot
saying
of things were mentioned.
The bleeding.
By the way, so was Lion Tree.
Lion Tree?
Aria Burkhoff's firm was
Oh my
mentioned.
God! Did they bother to mention Moffett Nathanson in that deal?
No, Moffett Nathanson's selling. By the way, did you know Silicon Valley Bank has a $41 billion market value?
Well, everyone does. There isn't any. If you don't have a $41 billion market value, you're nothing. But David, let's go back to the idea that there's a cultural phenomenon that the stock market is actually involved. And David, you know, I'm saying right now, no one was short Peloton involved with the Sex and the City. No.
Okay, good.
I'm saying that. There are people short Lucid telling me there aren't enough sold, and people short Rivian betting that Ford has to sell. But no, I'm not hearing a Peloton short Kiss.
Right.
It didn't matter. The stock has been so horrendous.
It has been. And do
But you know,
expect it to
Foley,
continue to
we
be?
should get
Yeah.
Foley. You know, Foley's actually a good guy.
SVB Financial Group,
I think he is.
$41.3 billion market value, buys Moffett Nathanson.
Peloton's still 12 bill. Maybe we take it down to like 7. What do you think? Like during the show, take it down to 7 billion. Call Foley, getting Chris Noth. This is crazy. How can this be?
How's your cardio? You good?
My cardio?
Yeah.
Yeah, but there's a lot of other stuff that I'm doing.
All right, I just
Brain.
make sure you're taking care of yourself.
Brain.
Can't lose you. All right. Let's give you another look at futures, Chris. We got a little less than 9 minutes before we get started with trading here at the New York Stock Exchange. We're going to squeeze in Jim's Mad Dash. A lot more Squawk in the Street when we come back. All right. Let's do a mad dash, of course, counting down to the opening bell, about 6 minutes or so, 5 minutes from now. What do you got?
I just want to talk about Coca-Cola, which was upgraded today. People at home are not used to hearing about HubSpot. They don't really want to know about Braze. They don't really care about Monday.com. They want Coke. And this is a situation where the company's going to do quite well. Body Armor's closing. They have raw costs are much more under control. So, David, the question is, what do you do with the Coke, which was a generic name? Where the street really wants you to buy Amazon. The street wants you to buy Microsoft.
Yeah, why? Well, first of all, that's one reason. I mean,
right. And the answer is you can't get performance from Coca-Cola. You can't. But I stand here, and I say to myself, what do we do with the fact that the vast majority of people want this kind of company as opposed to a name like Anplan? Like, just picking one of these various ones, or anything involving database. Snowflake, which has been terrific, by the way. Snowflake's work. I have MongoDB tonight. And when you're at a party, you see, listen, I got MongoDB. They think it's like, oh, is that a Comic Con? Oh, geez, I didn't even know about MongoDB. What strain is that?
Reminds me of Alex Karras from Blazing Saddles. It was Mongo. But
no, but I'm just saying that the disparity between what we know as companies reminds me of another era. Now, I don't know what
all right, but does it mean that names like this are going to start to come back
or
not?
This name outperformed in 2000, beginning in April of 2000. So when the market went down, people went to Coke. So I think that this is a really interesting idea. The issue is growth. It's buyback growth, it's dividend growth. But is it
nobody expects double-digit growth at companies like Coca-Cola?
But only Snowflake and MongoDB have accelerated revenue growth, which is what you need if you're a multiple sales.
Well, Berkshire still owns a lot of Coke.
Oh, Berkshire's none. They have Apple.
They own a lot more Apple than they do Coke.
The performance is derived by Apple.
Yeah.
But I'm just saying, I'm keeping this in mind because this is what started to do well when we had the collapse of the dot-coms.
All right. Got it. We got a lot more for you, including we're going to talk about that Dollar Tree fight there, Paul Halal. We'll talk a little bit about that, right? Coming up. Also coming up an opening bell, so don't go anywhere.
If somebody makes better cars than we do, then and they then sell more cars than we do, I think that's totally fine. Our intent with Tesla was always that we would serve as an example to the car industry, and that and hope that they also make electric cars so that we can accelerate the transition to sustainable energy. I'm confident in the future in Tesla that it will do well, and I hope some of these other companies do well too.
Elon Musk talking about Tesla in an interview with Time Magazine in connection with that publication, naming Musk its Person of the Year for 2021.
And you're looking forward to the presentation tonight, right? At the Person of the Year dinner?
Is there one?
Yeah.
Really?
Yeah, I'll go. Let's see it. What? Well, I've done ET. I've actually done crypto with Time. Remember, I tried to buy this debt cover using Ethereum.
Yes.
And I failed. But I kept the Ethereum, and it was the best trade I've ever had. And it wasn't meant to be a trade because it's not really, it's kind of like draft.
Do the opening bells, and I want to get back to Musk. Here at the, you see the CNBC Real-Time Exchange. We'll see how we end up there. Kind of a mixed bag so far. Here at the big board, Crescent Energy celebrating its listing at the NASDAQ. Software company Synopsys celebrating its
good company.
35th.
Touch. You know, David, we can go back to Musk for a second.
Yeah.
He's saying basically bring on Rivian, right?
Yes.
Bring on Lucid, which we might have made 500 cars, might have not, but certainly had a big convert deal. Bring on Ford. Ford's talking about the Mach-E. I hope they can make all those with batteries. Bring on GM. GM had a very big move last week. And that's Mary Barra basically laying out the investment case, which is a pretty good investment case. Mm-hmm. Man, David, these 10 and 9 times earnings stocks intrigue me. Earnings per share as opposed to whatever per share that people are trying to sell us. And that IPO list has just lost people so much money. I just can't. It's better just being an index fund.
It certainly seems to be. It's hard to argue with Musk not being sort of the singular figure in the business world right now.
I agree.
He is.
No, I know. It's just that, remember, this is Time.
It's a reason we talk about him all the time.
Business.
Yeah. I mean, listen, Time, we kind of knew this already.
It's got that North Korean premier haircut.
It's not just what he's done. Would EV sales be where they are were it not for Elon Musk? If there was no Tesla?
Yeah, well, I mean, Norway has said that you have to have them. By the way, Norway, they had a snowstorm. All the electric cars stopped.
Yeah. Norway's a small country. It's only got like 5-6 million people.
And they're all in the Olympics. Old country.
It's incredible. I was there during the Winter Olympics, and I was there during the Summer Olympics, and they are incredible.
But they didn't create snow?
I don't know. No. I mean, I was in Norway when the Olympics were going on.
Oh,
I was doing it was for the House of Cards documentary.
Oh my
Narvik,
God, that's
Norway,
and
it reminded me again of the fact that they win.
Right,
they win events.
They have a Norwegian
winter
sovereign
and summer.
fund. We need a sovereign fund. Why don't we have
amazing.
One? But David, everything was up in the early market is now down. Like Nvidia was up 3, now it's down. Apple was up 2, now it's not up nearly as much. I continue to think that the analysts are way out of. Way out. They're nowhere near what they should be writing in terms of the negativity. They're way off their message.
Well, all right. I sense this could change. I know that, but I sense a less positive tone from you today.
Well, I just don't want, David. I brought all these for one reason. Okay, because these are all buy recommendations.
Okay.
These are buy recommendations.
Okay. Show that to people.
This is a hold.
Okay. And so typically that means what?
People too bullish. Now, I was hoping in my investment club, I was saying, look, good opportunities. But not everything's an opportunity, for heaven's sake. Not everything is an opportunity. Not everything's going to go up. Sweet green. Is it time for ChargePoint, David? How about NXPI? I found a recommendation of Ralph Lauren. That may be the right thing to do, but how about Toll Brothers? Is it time to buy Roblox, David? No, it looks like it's going to be AppLovin. Okay? That's like AppLovin. Sounds like a group out of the 60s, like Paul Revere and the Raiders, AppLovin.
AppLovin. Well, it reminds
I remember them. I saw them at the Steel
McLovin.
Pier with Ed Hurst.
Well, one group that is up is largely up is pharma. Pfizer, of course, we told you earlier, is doing a deal as a percent of its market cap at $6 billion. It's nothing, but that stock is up. J&J is up. Got Bristol Myers up 2.5%.
Well, they did a big buyback, $15 billion, but nice boost to the dividend. Again, that's one to watch.
Yep.
Pfizer's loved because it got an upgrade, but also because it's clear that maybe a fourth booster.
Merck.
Peloton's up on Chris Knott saying, listen, all's forgiven. and Aviation Gin coming in there saying good things.
Move quickly, too quickly off. Merck did get a downgrade to neutral over at UBS this morning. No positive value inflection catalyst in the event path in 2022.
That was the only negative piece
the
the whole morning.
Has not performed well this year, certainly versus the group. It's down about 7%.
This is good. Is it better than Canopy Growth? Maybe it's doing a little better.
Might be a little better than that. They're not excited about molnupiravir, of course, the antiviral that I've spent a lot of time talking about. They're concerned about that reduction in efficacy that they saw in the study in terms of preventing hospitalizations and a couple of other things they
really dumped on Merck.
Yeah.
Really dumped on
it.
David, I want to, just in terms of bullishness, my charitable trust owns Disney. Now, here's a piece from KeyBank. Disney significantly undervalued. Significantly. Some of the parts, as if they're ever going to break up Disney. And then you've got West Side Story. Only the over 55 cohort, Spielberg wouldn't let it be on Disney Plus. So therefore, it's Disney forward.
It only did $10.5 million at the box office.
And it costs a little more than that.
It also opened to rave reviews, I think it's fair to say.
Yeah.
Is it because people don't go to the movies anymore? Or
now Adam Aaron's going to call in and say, how dare David Faber say that?
Why should Adam care anymore? He's only got 96,000 shares left to sell. He sold 313,000. The CFO's out entirely.
I think he's been very upfront about his selling. How about, don't you love that one of those reasons in terms of the risk factors of GameStop, insiders might sell?
Yes.
There's a risk factor. Yeah, there could be selling by people who've made fortunes, even though the company's earnings are no good. Oh, that's just, now I'm going to get hit by those people. No, I don't even care anymore. My mentions are so polluted. Unless I have a picture of my spaghetti sauce, I'm a dead man.
Let's talk Dollar Tree a bit, if we can here, because it is one of the more interesting fights going on right now in activism land. This guy Paul Halal, you may remember him from.
But they wanted to clean the
CSX
whole board up. That's ridiculous. Get rid of the board.
On Friday they nominate 11 directors.
Are you kidding me?
11 directors to take over the board. This is Mantle Ridge again. He raised outside capital for this in SPV. He's a well-regarded guy. I called him, by the way, and he wouldn't call me back.
Oh, well, that's impressive.
Had a PR representative call me back, and I'm not really interested.
Not Mantle Tree?
Yeah, not Paul Halal. I mean, really, come on.
He's been around for a while.
Come on.
Mantle Tree.
It's just a phone call.
Yeah,
we can even talk on background.
Mantle Bush. Honestly.
Anyhow, let me give you.
They offered him one, but that means obviously.
They offered Dreiling.
Right.
Who he's, associated with here, who obviously knows the company well.
Is it because Dollar Tree's not done as well as Dollar General? I mean, Dollar Tree's trying very hard. They bought Family Dollars. None of these guys, David, the whole group of people who did that they're not really represented. They're not, CEOs go on.
Okay.
I'm just saying that Dollar Tree, can we just accept the fact that 50% of their stuff is right now off some board in the South China Sea?
They may not.
I mean, they are
in many ways suffering as a result of that as well. Let me give you their side, though. We had a great story that
we're not even running. We had it this morning at 5. Like, that they're moving the boats away from, so it doesn't look like that they're off.
We talked about that on Friday. The Journal did that story. Remember, they're now you can't see them any longer at the LA port, but it doesn't mean they're not out there. They're also, remember I said they're going at half the speed. So they're coming in much later.
But if you're Dollar Tree, David, where do you think they make that stuff? Do you think they make that stuff in Connecticut?
We know where it's made. We know it's made in China, and then it ultimately fills up.
Well, a lot of people are talking about Vietnam being so great. And
will you let me read from what Dollar Tree had to say? Will you please? Okay. All right. Thank you. Mantle Ridge offered no new ideas for how to improve the company's performance or operations. The only operational suggestion made that the company should sell Dollar Tree merchandise at Family Dollar stores is something Dollar Tree's already been doing for several years. Instead, Mantle Ridge simply expressed that it wanted a majority of the board to be replaced, Mr. Dreiling to be named executive chairman, and other control rights.
All right, so the stock's up 29%. I mean, can't we go after something that's like not up? I've got about 150 companies that are down for the year.
I will say, in finishing up our quick coverage here of this Dollar Tree fight, I will add Wells Fargo to try and be fair, even though Halal won't return phone calls. The quality of the 11 candidates nominated to Dollar Tree's board of directors is undeniable, says Wells Fargo. as the slate includes many highly regarded former business leaders. Their plan for improvement seems fairly clear to us, given Dreiling's involvement. It's now clear he's open to doing whatever it takes to help Dollar Tree realize its potential. Okay, Jim, now I will give you the final word on this. Buy, sell, or hold?
Well, look, they have union. Well, they have problems. Are people going to unionize? Remember, like the Starbucks, I haven't had.
Buy, sell, or hold, Jim?
Dollar Tree, buy.
Yeah. Okay.
I mean, they're doing everything they can. And in an environment where there's 50% of the people are not really benefiting from this fantastic market and this fantastic economy, Dollar Tree remains indispensable.
Thank you.
I happen to like them much more than my Dollar Gen is not as nice as my Dollar Tree. Brand new Dollar Gen just opened near me. I haven't checked that out. But David, as between Dollar Tree and Apple, which you think is more important to talk about? Because people are beginning to talk about the 5G cycle being underestimated.
I think I would want to talk about Apple a lot, and we do, and we should, because that $3 trillion, just to make the point, it's $100 billion companies. There aren't many of those to begin with.
No. I mean, I think that if you didn't own Apple or Google, a couple of those, then you should be an index fund because it's obvious. That's where the performance came from. Unless you're in something that's so special situation. And there aren't that many special situations this year, meaning mergers, because there haven't been as many in the second half of the year, I think because of FTC.
Yeah, the deals that we continue to see are the likes of which we talked about this morning. Obviously, the Pfizer deal. You've got this SPX Flow. It's a private equity deal being acquired by Lone Star, $86.50 a share in cash. It's like a $3 billion or so, I think. That's the kind of deals that are getting done right now. By the way, benefiting the investment banks and all the advisors. It's a very strong M&A year, but not headlines.
No.
Not stuff that we're going to spend a lot of time talking about, not huge strategic deals because of fear of antitrust, both at the FTC and Lena Khan and what that represents, and the DOJ. It doesn't mean we aren't going to eventually see some of those, but you're going to have to be prepared potentially for a court fight if you want to get it through, if it is a real headline deal with any real antitrust risk associated with it.
There's
Jim,
been no consolidation in this tech area of customer relations, no consolidation in the database industry. There's no consolidation in an industry that is being roiled by Snowflake, by the way, in terms of not Rent the Runway, but Rent the Cloud. And then there's been no consolidation in the Rent the Runway, ThreadUp, Real World, which is just a disaster.
Right.
So I'm saying that
Rent the Runway and Real all
they
get
all
together.
need to get together and be bought by Macy's.com.
Maybe that'll happen.
No, I mean, I just think, we can talk about any company and we just say, well, if we're not talking about Meta Platform and we're not talking about Apple, we're not talking about NVIDIA, which we haven't even mentioned.
Got an interesting one here that combines two different things, EV and SPACs.
Oh my God,
and that's Harley Davidson. Have you taken a look at the stock?
Finally up.
It's up 18 plus
Finally.
19%. There it is.
There you go.
On the announcement that they are, in fact, going to take Livewire, which is their EV sub, and they're going to merge it into a SPAC.
There's so many ESG funds. I mean, for instance, I had ASEC on Friday. They make artificial faux wood. About 55% of their wood is from plastic, but Trex is almost 100% recycled. Pretty much, Trex is up 65%.
Right.
ESG factors matter tremendously. And there suddenly we have an ESG motorcycle company.
We do.
So
we do.
let's just
it's interesting that they've chosen to do this, and it obviously will separate it, give it its own valuation in the market. They will still own a good amount. $400 million cash in the trust at the particular SPAC. They're going to have $100 million investment from Harley Davidson, another $100 million from another firm through a pipe. Enterprise value expected at $1.77 billion. Post-money equity value, they're saying at $2.3 billion. That would be a close. And interesting choice on their part to use the SPAC structure to actually take that public. Obviously, you can do it more quickly, potentially.
Give me the other side, David. Do you think that there were a number of SPACs bidding for this piece of business?
Absolutely, without a doubt. As we know, there are 581 SPACs
in search of businesses.
568 SPACs.
In search of what?
In search of a deal. 568 SPACs in search of a deal. And by the way, some of them are falling apart, like this SCVX and Bright Machines, they mutually agreed to terminate their business combination. SCVX is back. You're seeing those every so often. The eToro deal, they pushed off again. So, yeah, and then you got 5 or 68 of them that are looking for a deal.
But, David, okay, so let's just be...
not going to happen.
Let's be business people, you and I.
Okay.
David, I'd like to... Why don't we get a half a billion and try to find a business to buy? Well, how about this? How about we try to find a business to buy and then get the half a billion?
Oh.
Then what would happen?
Then
I wouldn't get my fees. I wouldn't get my pipe. I wouldn't.
Your friend who runs the FCC, Mr. Gensler, Chairman Gensler, would not be happy with you. The SEC. Yeah.
The Gensler video is one of the greatest videos. I mean, it really is. He uses a lot of new media. I don't know. Maybe he used Monday.com or HubSpot. It's not really clear.
All right. You ready to talk to Pisani? I think I am.
Yeah.
You
you mentioned AT&T today.
Oh my God, AT&T's down another 1.8%.
Well, that's why I mentioned it. It's a moving target.
I think it could be because they killed off Mr. Big?
I don't know. Did Foley come back to me yet? Well, I'm getting Chris North. Just a second.
That's horrible. By the way, Fox is down 2.5%. You think that's because Chris Wallace is leaving?
I know.
By the way, Discovery and AT&T are both down.
Did you get that?
Continuing to pressure that the overall value of that potential deal when Discovery actually ends up merging with the Warner properties that are part of AT&T. Remember, AT&T shareholders will own over 70+% of the combined company. You have to figure out whether it's going to be a split or how they're going to structure it.
But that 9% dividend yield is not for real. Okay, it's not for real.
No, the AT&T will reduce its dividend once the deal is complete, which could be, by the way, as soon as, let's call it April of the coming year. All right, let's get over to Bob Pisani right now for more on the market as well. Bob.
And good morning, David. We spent close Friday, big rally into the close, new highs. You see what's going on here. Very hesitant, and part of it is because we're still dependent on the Omicron headlines. Boris Johnson didn't help us, talking about tidal waves of Omicron coming in a few hours ago. That took the futures off of their highs. You see how defensive everything is today? Healthcare and consumer staples are up. Tech's up because Apple is still holding up very well. Most of the rest of the big FANG names are flat to down. Semiconductors are split right now. So it's really Apple holding up tech. And energy, industrials all weaker. You can see this in the Dow. I mean, look, we're sitting at the lows for the day. What's holding up the Dow other than Apple is Coke, Walgreens, Procter & Gamble, Johnson & Johnson. It's all defensive other than Apple. What about some of the cyclical names? Where's, for example, any of the banks? Where's Goldman? Where's JP Morgan? They're all down 1 to 2%. Most of the industrials are down as well. So you see a lot more hesitancy here today. If you take a look at what the headlines, what's moving markets, again, Omicron headlines moved the market. More optimism last week, less optimism this week, to the extent Boris Johnson reflects some of those concerns that they've had about Omicron, and because that Omicron headline affects the supply chain issues. So we're sort of dependent on the variant headlines for supply chain issues as well, and inflation. And you see how all this becomes very interconnected. As for the Fed, big story, of course, they'll be out on Wednesday with their comments. The bulls want to believe that they've become hawkish enough at this point, that the CPI report, they keep pointing that, that could have been viewed negatively, but the Fed changed. And so it was viewed as a positive. Essentially, we'll be able to handle it. We'll see what happens with that. Remember, the important thing is markets want guidance that it's going to be gradual. They don't want aggressive rate hikes. Maybe 3, but again, the question is, what's the terminal interest rate? It was 2%, 2.5% in 2023. We don't know. That's what the guidance we want. Earnings estimates have been very steady, but remember, usually it's quiet going into earnings season a couple weeks before that. So we'll see. The good news is they're not dropping. They're holding up. As for where the markets are, NASDAQ has announced the additions to their NASDAQ 100. And I just want to show you here, these companies all were trading up in the pre-market because these ETFs have become enormously influential. When you have the triple Qs, adding and subtracting or anything like the S&P 500, your market has to buy into these stocks and then, of course, hold them for a very long period of time. There's $1 trillion in inflows into ETFs this year. Most of it has gone into plain vanilla ETFs like the triple Qs, the NASDAQ 100, and the S&P 500. So when these announcements are made, they're major events, these stocks all trading up, and the ones that are being deleted And this is the NASDAQ 100. This is a mechanical process. It's the biggest non-financial stocks in the NASDAQ 100. When it's being deleted, put up the deletions here, those stocks tend to be trading down. And that's exactly what was happening in the pre-open. Finally, David was mentioning the IPOs. I just want to put some meat on the bones on that about the post-market announcements, because we've had a tremendous number of IPOs. And generally, the first day pop has been terrific, 31%. The historic average, in case you're wondering, is 15%. So there's been enormous first-day pops. Not only have they got high prices, they've gotten significant first-day pops. This is like heaven for a guy who's issuing stock right now. But David, as you mentioned, the aftermarket, look at that, down 17%. Now, why is this happening? It's happening, David, because it's a buyer's market. They're able to price high, and because demand has been so high, David, they're getting it in the first day. But the average CNBC viewer who might be buying it at the end of the close of the first day, they're the one who's not very happy. And maybe we can get them to lower the prices in 2022, David. How about that for an idea? Back to you.
Bob, thank you for filling us in on that. That performance number showing it, I think, shows it. And also on why Fox is down, because, of course, I was half serious on the Chris Wallace departure, but it is because it's being it's exiting that NASDAQ 100.
I would love to find the average viewer who got gaffed.
Yeah. Say again?
I said the average viewer. I'd love to get the average viewer and just have them sit there and say, you were gaffed by a bunch of deals. What happened?
Okay.
Which one did you get sucked into?
Let's get an average viewer. Let's do a bond report, though, before we head to break real quickly for you all. Let's give you a look at how treasuries are faring this morning. You saw it earlier. Yields are hanging right in there at about 1.445 on the 10-year, and the 30-year at 1.825. We'll be right back. As a reminder, Yep, you can get in on the new CNBC Investing Club with Jim. Sign up, find out more at cnbc.com/investing club, or just point your phone at the QR code on your screen, or even if you see Jim in person like I like to, just point it at his head and it will come right up. We'll be back after this. Welcome back. Just enough time to find out what's on Mad tonight.
Exciting show. MongoDB, one of the really the best other than Snowflake that's still staying up. And then David, Craig Moffett, to congratulate the Moffett-Nathanson people for a terrific deal from SIVB, which is a very big company. And then Michelle Eisen is a barista. I just feel like everyone knows I've been very pro Starbucks over the years. I just feel like it's important to present the other side. Not that I necessarily agree with it, but why not put them on?
Interesting. Okay, just a barista or a specific?
Well, it's a person who's been quoted a lot. It's been a leader.
Great. Great show.
Thank you.
All right. I'll see you tomorrow.
Rivian flying.
Yeah, Rivian's
Get
up.
Ford to queue up its stock.
Rivian's up sharply. Speaking of EVs, by the way, we're going to have the CEO of Harley Davidson on its electric motorcycle division going public via SPAC. He'll be joining us. Keep it here. Monday morning, and welcome to another hour of Squawk on the Street. I'm David Faber with Morgan Brennan. We're live from Post 9 at the New York Stock Exchange. Carl Quintanilla has the morning off. Let's give you a quick look at the markets at this hour. You can see we are down on all of the major averages.
Well, we're 30 minutes into the trading session. So here are three big movers that we are watching this Monday morning. We're going to start with Pfizer, with a new Israeli study showing that its booster shot provides strong protection against the Omicron variant. Separately, the company also announcing a deal to acquire Arena Pharmaceuticals for $100 per share in cash, or about $6.7 billion. You can see those shares are jumping about 4% for Pfizer right now. Plus, Peloton pedaling higher after a race to release an ad over the weekend featuring actor Chris Noth after his character's death in the Sex and the City reboot. That was following a ride on a Peloton bike. It also includes Ryan Reynolds, the commercial, by the way. And you can see those shares are up about 5.5%, although it'll be interesting to see what the marketing spend on that commercial was. We'll end with Harley Davidson. Those shares are revving higher as well after the motorcycle maker announced it is taking its EV division, Livewire, public via SPAC. We're going to discuss that exclusively with the CEO in just a few short minutes, David. And as I mentioned, those shares are up something like, 18% right now.
Yeah, I'm looking forward to that interview. Hear what their strategy was behind that decision. We're also keeping, of course, a close eye on shares of Apple this morning. It has been closing in on that $3 trillion valuation. As you can see, what is it, about $30 billion away? Joining us now is Loop Ventures managing partner Gene Munster. And Gene, I know you can remember $1 trillion and $2 trillion. I mean, you can remember way before $1 trillion. And I venture to say you've been bullish pretty much all the way up and continue to be. Why?
David, it's based on a simple logic and framework I've used all along, and I've always wanted to get it right on the way up and be the first to call it when it's ready to go down. But that simple framework is based on a truth that investing in period, and in particular investing in Apple, is related to predicting what's next. And in Apple's case, they have had these what's next every 5 years. They've reinvented themselves, whether it be the iPhone, services, and here we are at the cusp of yet another reinvention. Potentially two reinventions. And that's why I remain optimistic. I believe that the company's best days are yet to come. And I just want to quickly frame in the optimism is that we have the core business is predictable. It's having a headwind with the supply issues that we can talk about. But really fast forwarding beyond those supply constraints is that the two big opportunities for the company are centered in the metaverse and autonomy. The metaverse is going to be real for Apple. They will have hardware. We think that they will preview in 2022 mixed reality goggles. It's going to take years for these to become mainstream. But again, investing is about what is coming next. And that is something that can be material to Apple's business. And then, of course, there's auto and autonomy. And I'm cautious about endorsing this theme too much, given my mistakes around the television in the past and seeing what Apple works on doesn't necessarily see the light of day. But if I can just quickly frame in the auto opportunity, is that they have 20% market share on mobile today. If they get 10% in auto, that's a $540 billion business. They're going to do $380 billion next year. I mean, this could be massive for them. Again, caution, we're years away, but the point of investing is to be in front of these curves. And when you put it together, to have that optionality in trading at under 30 times, I think is a bargain.
So, Gene, let's just dig into that a little bit more, because the recent rally we've seen in Apple shares, even amid a broader market downdraft, I guess that was last month now. I mean, Apple was being perceived as a flight to safety, given the fact that it has this pipeline with all of these future innovations in it, which may or may not see the light of day. Does that change the thesis there?
Well, you have a core business that can backstop you to $200. My previous price target was $200. That excluded the multiple expansion on the metaverse and what can potentially happen around autonomy. So to answer your question, Morgan, is that I think that there's upside based on the core business. This is related to the accelerating digital transformation. They've had some, I would call it wins recently in the courts regarding some of the steering and around services. I think when you put that together, this is still just a sleep well at night company and should be $200. But then it begs the question, do you own it from 180 to 200? That's a decent return. But for the real upside to kick in, I need to be right on this, that they need to get into one of these two. I feel with high conviction that they're going to do something around mixed and augmented reality and glasses in the years to come. And I have high conviction, despite my apprehensions about the world of the metaverse, that it is the future. And then, of course, the car. So to answer your question, Morgan, is if I'm wrong on both of those, I still think there's upside to the stock.
So then would you call Apple one of your key metaverse plays? Or if, as an investor, you're only going to put your money to work in one or two names, would it be somewhere else?
For the metaverse, I think you do a basket. I think it's Apple and probably a company that we're investing in, Coinbase. We see that as the bank of the metaverse. So that is an opportunity. Of course, if I can, you said two companies, and if I can stretch here, I think Meta, aka Facebook, is going to be a participant in this as well.
Finally, just to come back to the multiple, Gene, you see or you believe that 35, I think, is reasonable. Obviously, this outperformance versus the S&P has brought the multiple to, I think, a higher level, certainly than it had been. Why are you confident that it can sustain, a multiple that it's rarely seen?
So, as you said, it's rarely seen. It has been seen before. And I think this is, where's my confidence is it's not just about new product segment, new products. Apple comes out with new products all the time. They don't have this kind of lift in the potential. It's about the size of the addressable market. So to answer your question is, we framed in what the auto market is. The metaverse is just essentially it's the next version of the web. It's those type of opportunities. And I do want to acknowledge that investing based on multiple expansion is dangerous. I think that there is risk because you're basically predicting what psychology is. But nonetheless, that's my job, is to try to make a bet on what the future is going to be. And in this case, I think it's going to be deafening, the enthusiasm in the next couple of years about these other markets that Apple's going to get into, and that will push the multiple higher.
All right. Well, as we've been talking, the stock has moved up ever so slightly. Only $25 billion to go, Morgan, until we see our first $3 trillion company. Gene, thank you.
Thank you.
Well, let's turn now to the broader markets and the Federal Reserve, because it's a big week for that as well. Our Steve Leisman is looking at how both the equity and fixed income markets have priced in a more hawkish Fed outlook ahead of this week's meeting, and whether that's enough. Steve.
Morgan, yeah, another strong inflation report we got Friday with a promise of more inflation to come raises the question whether the Fed may have much more to do to get control of rising prices, not just taper faster or even raise rates earlier. Markets already have that priced in, but actually move to slow the economy. Here's a preview of tomorrow's Fed survey. We asked if the Fed eventually could have to raise rates above neutral and slow the economy. 45% think it's a possibility. 48% said no. So pretty close for our 33 respondents.
The big risk is that by being so late and going so slowly, they may have to hit the brakes. And that's not something that the economy or the marketplace will appreciate.
Rapid changes in the Fed's own policy outlook mean that most forecasters are only now catching up to where the market is. They brought forward their estimate of the first rate hike into the spring or early summer. But is that enough given the current inflation outlook? The Fed futures market, you can see there priced in a May rate hike, a second hike in September, and a third one in December. That put the Fed funds rate, call it 90 basis points at the end of next year, with the question whether or not March is even a possibility for the first hike. Investors, they're going to get the Fed's own projections. They'll be published Wednesday, and they'll see how aggressively the Fed is forecasting the path of the funds rate. The real Fed funds rate, take out inflation, it's minus 6.8%, the lowest on record. The Fed has an awful lot of work to do to get to neutral. The question is whether markets have priced in that amount of tightening. Guys?
Steve Leisman, thank you. As we head to a quick break, here is a look at our roadmap for the rest of the hour, including a first on CNBC interview with the CEO of Harley-Davidson, which is taking its EV division public via SPAC.
Plus, the carnage in crypto continues. Bitcoin is now down more than 15% since the start of the month.
And 6 more astronauts getting their space wings following Blue Origin's big launch over the weekend. We're going to talk to one of those paying passengers on board. We have a big show still ahead. Don't go anywhere with the major averages all in the red. Welcome back to Squawk on the Street. Shares of Harley-Davidson surging this morning, up about 14% right now, announcing that its LiveWire division will become the first publicly traded EV motorcycle company in the U.S. This will be under the ticker LVW. LiveWire is merging with AEA Bridges Impact Corporation. This is an ESG-focused SPAC, giving it a pro forma enterprise value of about $1.8 billion. Joining us now, first on CNBC, is Harley-Davidson CEO and Chairman Jochen Zeitz. Jochen, great to have you on the show. I should note you're also going to be acting CEO for up to 2 years after this deal closes of LiveWire as well. LiveWire has been in the works at Harley-Davidson for about a decade. So why are we seeing this deal happen now, and why are you doing it via SPAC?
Hi, Morgan. Well, it's a great opportunity. This is really a win-win-win for everybody involved. We have great partners in this transaction with ABIC and with Kimco, and of course Harley-Davidson in the background that will help support this for LiveWire to really become the leading electric motorcycle brand in the world. I've been involved in this process for 10 years. I've actually been on the board. I set up the sustainability committee for Harley-Davidson and pushing very hard to think long-term and think electrification. So after having been given the opportunity to become the CEO, I put that on the fast lane, and electrification is part of the Harley-Davidson Hardwire strategy. And through LiveWire, we can really spearhead the electrification of the sport. And that's why taking the final ultimate step to spin it off is just a logical thing to do now.
Yeah, I mean, you came on as CEO of Harley-Davidson back in 2019 in the midst of really a struggling secular decline that we're seeing not only at Harley, but across the broader motorcycle industry right now, as that core ridership has continued to decline. You've propelled this multi-year turnaround strategy that's called Hardwire as well. So to be able to stand LiveWire up on its own as a standalone brand and merge it with a SPAC, what does that enable, not just for LiveWire, but for Harley as well?
Well, every crisis is an opportunity. I really saw a huge opportunity, especially in a time when people were locked down at home and just wanted to get out and ride. And we see a great surge in new riders coming into the sport. Riders also getting onto their bike and ride. So there's a great opportunity. Harley has had very special moments in its history, and this is one of these special moments and a true opportunity in a horrific crisis. And I believe that the strategy that we have for Harley-Davidson will benefit, because eventually we will also electrify Harley-Davidson, but LiveWire will spearhead that development through innovative technology and focusing more on the urban consumer. And then bringing the technology back into Harley is obviously a key objective. Therefore, it is accretive, it's positive. While we have huge potential still for Harley-Davidson as a brand and as a company, this will be one of the key strategic elements that will help us to achieve our ultimate goals.
So would this enable that Hardwire turnaround strategy to achieve its results faster than previously forecast?
Well, it's one of the 6 key elements, and everything's on the fast lane right now. So electrification is critical. It's a long-term goal also for Harley-Davidson, but we still have tremendous opportunity with our core existing business, whether that's with motorcycles, but also in adjacent businesses like general merchandise and parts and accessories. We see great opportunity for the brand that is based on adventure and freedom, and we see good growth opportunities in the coming years that we will tap into.
You mentioned the urban rider. I mean, we know that core baby boomer rider for the classic Harley brand. What does the core ridership look like for an EV brand?
Well, it's certainly a new generation of riders. That is not to say that Harley is not really targeting its product also to a new target audience. We've just launched this year our Sportster S and our Pan America. We became market leader in the adventure touring segment in the US overnight. So there's great opportunity to expand our various customer profiles, all the way from our traditional core customers also to new customer groups that we're targeting. But for LiveWire and electric, it's a new set of consumers that have a different expectation in terms of the technology, in terms of the feel and look, and that's what we're really targeting with LiveWire.
Yeah, it looks like the EV ramp is going to be pretty dramatic over the next couple of years. $33 million in revenue for LiveWire this year, to up to $1.8 billion in potentially profitability in 2026. How does that take place over the years between?
Well, it's not going to be linear, of course, and a lot will depend on when we launch new product into the market. We have with LiveWire one a terrific product, but we are also planning to launch new products into the market based on our new Aero technology. So there's lots of opportunity there to grow the business. And if you look at the overall adoption rate, we see that increasing dramatically over the next few years. Adoption for EV, infrastructure is being built, auto is helping us, and the technology is getting there as well. So exciting product, better infrastructure, and of course incentives will also help to fuel the EV growth.
How many EV models do you plan to develop? How quickly will they roll out? And what does the pricing look like?
I will hold that answer until early next year, but we have several platforms that we are developing over the next 5 years, and we will hope to have some news about that early next year. But right now, LiveWire is our one model. I've actually prototyped and tried our next model already. It's an amazing product, and coming to you soon.
Okay, well, we'll keep an eye out for that. In the meantime, more broadly, I just want to get your take on what you're seeing in terms of the supply chain right now. Harley, like so many other companies across so many industries, has been affected. It has not been immune to some of the materials costs, to some of the parts and supply shortages we've seen as well. What are you seeing? How are you navigating that into 2022? Any signs that it's subsiding?
I would say probably we can be hopeful for the second half of next year. We still see challenges going into the next year. They're not going away. I think the team has done an extraordinary job to minimize we actually didn't have any blackouts. We had some brownouts, but to really keep at it and get the products to our customers, we've done as good as we could. And compared to our competition, I think actually a lot better. But this is not going to go away. It's a daily battle, but we are, I think, well placed to take up the challenge.
Jochen Zeitz, thanks for joining us here on CNBC on the heels of this news, the CEO and chairman of Harley-Davidson.
Thank you.
As we head to a break, keeping an eye on shares of AT&T, you can see that is the performance of the stock since it announced that deal, of course, to combine Warner Media with Discovery. Remember, AT&T shareholders will own 71% of the combined company. The deal moving ahead quite nicely, but the stock has not performed well at all, as you see, down some 30%. It hit a 52-week low today. No real news, perhaps just tax loss selling. We are at that time of the year, and certainly this would be when you sold for that reason. Remember, they're getting $43 billion in cash, obviously also going to hold some debt securities and the like. We'll be right back. Stay with us.
Welcome back. It's now time for our ETF Spotlight. We're taking a look at the Consumer Staples ETF, ticker XLP. Snapping a 4-week losing streak. It's basically flat right now. On pace for its best month since November 2020, though. Some of its top holdings off to a fast start this December. Hormel already up double digits. PepsiCo and Coca-Cola are also up sharply. David.
Thank you, Morgan. Well, sticking with the consumer and bringing inflation into the mix, our Christina Partsinevelos is in Texas. She has a look at how a global shortage of nitrogen fertilizer could impact your spending at the supermarket. Christina.
Thank you. So fertilizer prices, we know, provide nutrients to crops. And right now, prices are shattering records, leaving farmers almost little choice but to pass on the cost to consumers. Here at this farm in El Paso, Texas, just outside of Del City, or in Del City, they produce everything from cotton to grapes. And the owner told me he's never seen prices this high.
Fertilizer for somewhere around $220 a ton, and the last quote I got last week was over $850 a ton. And in the long run, it's going to be very interesting to see how we're going to have to sharpen the pencil to get through 2022.
Nitrogen-based fertilizer relies on inputs such as natural gas and coal. We know prices have been through the roof because of shortages, because of supply chain issues, because of export restrictions from Russia and China. And so this has created headwinds for prices, so much so that 6,000 farmers just last week alone asked the Department of Justice to look into whether there's any market manipulation in the fertilizer market. And so what we're seeing is food prices actually climb to levels that we haven't seen in the past year. This is according to the United Nations Food Index, and experts are warning it could get a lot worse next year.
Little bit of lift in corn prices, but I wouldn't say we're fully accounting for what potentially could be big changes. I think beef prices will have to inflate higher as feed costs go up, and so I don't think there's any relief around the corner for consumers.
Fertilizer prices touch almost every single item on your dinner plate. And so when energy prices climb higher, it's no doubt that food prices will soon follow suit. And I know the owner of this farm was very adamant that farmers be part of the conversation that goes on at Capitol Hill, or else we are going to see further pinches to our wallets and something that's going to be faced in the year 2022 when it comes to our grocery bills, much longer. So I'll toss it back to you.
Christina, it's such a key part of the conversation, especially given the fact that the narrative around food prices, for example, are that they do tend to be transitory. They do tend to ping pong and be volatile as well. And it sounds like when you're talking about something like fertilizer prices, there's a potential for that to be much stickier. I wonder what it means in terms of the potential for new types of innovations or ways to, I guess, fertilize crops could be adopted.
Well, that was an excellent point, too. I spoke about it with Jay Hill just in terms of using cow waste, pig waste. I know there was one story trending where people were like, oh, you can start using human waste as well. So they are looking at alternatives as well as carbon capture, which I think is a very important part of the conversation. They're storing these nutrients in the ground. But because fertilizer prices are so high, a lot of farmers are now having to take out those nutrients from the ground and use that for their crops. So it's almost like these high prices are taking away from their green initiatives in a way. But overall, yes, there are alternatives. And the eventual goal will be to not be so reliant on fertilizer prices, Morgan.
All right, Christina, thank you. By the way, get some good Tex-Mex for us down there. Christina Partsinevelos, reporting from El Paso. As we head to break, we're keeping an eye on some big moves among the meme stocks. AMC continuing its slide in the days after its CEO and CFO sold more than $10 million worth of stock. That's something David's been watching pretty closely. GameStop also extending its recent declines after reporting results last week. Both stocks are down more than 20% so far in December. We're back in 2. Welcome back. I'm Rahel Solomon, and here is your CNBC News update at this hour. The death toll from this weekend's tornadoes may be lower than initially feared. Kentucky Governor Andy Beshear says that 64 people are confirmed dead. Initially, however, he estimated that number could top 100, and tens of thousands still remain without power in Kentucky. The UK is reporting its first death from the Omicron variant. Health officials say that Omicron is now responsible for 40% of new COVID cases in London. Long lines formed at vaccination centers after Prime Minister Boris Johnson urged all adults to get a booster shot to improve protection against the new variant. Former FDA Commissioner Scott Gottlieb says that other nations should take note.
Concerning to see the British take this stance because they have very good data, they have very good systems in place. And so if they're seeing a very significant threat from Omicron, I think the world should really take notice of that.
And a small study from Israel finds that booster shots from Pfizer and BioNTech give good protection from the Omicron variant, but those that without a third shot remain highly vulnerable. You're now up to date. Morgan, I'll send it back to you. Rahel Solomon, thank you. We're just going to get a quick check on the markets here, given the fact that we are at session lows and we have seen an acceleration in the selling to start this Monday morning. You have the S&P down about 0.7%, 4680 is your level there. The NASDAQ is also down about 0.7%, and the Dow Industrials is about down nearly, we'll say 0.9%, or 327 points. Energy and consumer discretionary stocks feeling the greatest pressure, while it's more flight to safety sectors like real estate and utilities, as well as healthcare, that are in the green.
All right, turning back to, technology stocks, broadly speaking. Our next guest is framing the evolution of the internet as Web 3.0, the transition to an increasingly decentralized, more flexible global internet supported by the development of the metaverse. Joining us now is Goldman Sachs' Eric Sheridan. And Eric, just explain what I just read to our viewers so that they can understand a little bit more of what you're actually talking about here.
Sure, and thanks for having me on, David. Basically, what we're talking about is we are in the later innings of what we would call Web 2.0. That was the transition from desktop computing to mobile computing. There will now be a next generation of computing, or a next wave of computing, that we're continuing to follow, where you're seeing the rise of certain technologies that are in support of decentralization. You could eventually see the breakdown of some of the walled gardens that exist in Web 2.0. We think you could see things like the rise of the creator economy, the rise of privacy, and in addition to that, the metaverse, which is a topic that first started getting talked about over 20 years ago in science fiction and has gained a lot of popularity in the last 6 to 12 months, is this idea of augmented reality, mixed reality, and there'd almost be an element of you being able to put yourself into elements of a wider next version of the web, possibly in the form of avatars and things like that, where you could have experiences, you could consume media, and most of it would be much more decentralized than the application store distribution model that you're used to in mobile computing via smartphones.
Yeah, I would argue as well, a lot of us got focused on the so-called metaverse when we saw that $10 billion spending number from Meta, I wanted to say Facebook, after the last quarter, Eric. I mean, that was a stunning number for just 1 year. And I wonder, what's the opportunity there? Is it the spending by those who are building the metaverse, as well as those who are actually going to kind of, I guess, be in charge, so to speak, like a Meta?
So I think there's two waves we need to think through here. I think you articulated it well. The $10 billion number, which, by the way, didn't come from zero. You know, the Facebook, now Meta platform, bought Oculus in 2014. So they've been investing behind this technology on both the hardware side, the software side, and the content side for years. Now they're giving us a piece of disclosure that we can build off of, but the investment started years ago, and we think the investments are now going to build over the next 2 to 3 years. So I think first you're going to have the investment cycle. Do we get consumer hardware down to a price point that's attractive to a wider array of consumers? Do we develop use cases that can be distributed and cause people who are going to go out and buy this type of hardware? There's always that tipping point with computing of when the hardware and the use cases match up with each other in a way to make it mainstream. So we're going to be watching the investment case over the next 2 to 3 years, and then the emerging use cases over the next 3 to 10 years. And what we did in the report was give some scenarios scenario analysis around it. I know these are wide numbers, but the idea that you could see anywhere from 100 billion to $1 trillion of investments that could have an output or a throughput of something like 2 trillion to 12 trillion of a monetization curve. And at its core, all we were trying to do there was say, let's look at the digital economy. Let's continue to grow that as part of global GDP, then have this virtual economy growing within the scope of the digital economy to provide investors with a scenario analysis.
Okay, so with a 3 to 10 year time horizon, with what we're talking about here in terms of investment and then use case scenarios, best places for investors to put their money to play this right now?
Yeah, what we said in the note was the 3 most exposed names by the team and I in the broad internet or gaming sector would be Meta, formerly known as Facebook, obviously at the leading edge of trying to lead this transformation. Snap, which most people don't think about, but it's primarily an augmented reality first company. Now that's augmented reality by using the camera on your phone and some of the overlay technologies that we talk about in the report. And then Roblox, which is covered by my colleague, Mike Ling. Roblox obviously is basically a metaverse first company in the way they describe themselves.
How does Bitcoin and cryptocurrencies factor into all of this? Because we hear that that's going to help, I guess, lay the infrastructure from a payments standpoint for this Web 3.0.
Yeah, I mean, there's a lot to unpack there. I'll try to do it very quickly. I think there's going to be technologies built on blockchain that are basically decentralized in nature. I think because the asset value of crypto has gone up, people associate crypto with decentralized web. But you could see other forms of currency emerge. For example, my 14-year-old son asked me for US dollars that he turns into virtual currency in video games. That's an element of virtual currency we could see. So I'm not sure we necessarily would tie all those themes in a linear manner together, but I think there's an element of decentralization that ties through all of these themes that we'll have to continue to watch in the years ahead.
Eric, we will be doing that. I'm sure we'll be talking a lot more about it in those years ahead as well. Thank you.
Thanks for having me on.
Well, we're going to stick with that concept. Bitcoin continuing its move lower for the month, now down about 15% since December 1st. Our Kate Rooney has more on the recent slump. Hi, Kate.
Hey, Morgan. Yeah, recent Bitcoin selling does appear to be coming from some of the short-term holders. So those are those investors who bought at a peak here, and they may be throwing in the towel at current prices. So short-term meaning they're newer to the market and only bought in the last few months. And in many cases, these are the smaller retail investors. Bitcoin is trading below the average cost basis for these traders, or the price where most of them got in. Right now, that's around $53,000, according to Glassnode. Bitcoin today trading about $6,000 below that level. And there's a metric analyst also watch closely called the short-term holder SOPR. This shows the profitability of coins when they are sold. And right now it's showing a lot more Bitcoin being sold at a loss or below the price where it was bought. These are the least profitable levels in the last couple weeks now that we've seen in 6 months. Glassnode analysts say this group of these newer buyers appears to be the only cohort reacting significantly to the events of the last couple of weeks, while more mature or those longer term holders remain unmoved. They also say those who are spending coins appear to be predominantly those who bought at the top and they're realizing losses and capitulating here. As for those long-term holders, they're sometimes described as the smart money in crypto, and there's been a lot less activity among that group at these current price levels. And finally, guys, take a look at the bigger investors, those who hold more than $10 million worth of Bitcoin. That total number of so-called whales has dropped since early November, but the total supply held by that top 1% has continued to increase. They appear to be accumulating more coins. That's according to data from Genesis and Coinmetrics. Back to you.
Kate Rooney, thank you. After the break, we're going to talk to one of the 6 astronauts on board Blue Origin's space flight from over the weekend. We're back in 2.
One of Wall Street's all-stars is bullish on the market, but his forecast excludes some of the most popular groups. Rich Bernstein opens his playbook on tradingnation.cnbc.com. More Squawk on the Street ahead. We've talked metaverse in this show. Now let's talk multiverse. Jeff Bezos' Blue Origin completing its third human flight past the edge of space on Saturday. It was the sixth flight of the New Shepard suborbital capsule and rocket for 2021. This was the NS-19 mission. It marked the first space flight with a full crew of 6 passengers, including former NFL star and Good Morning America host Michael Strahan. Also, Laura Shepard Churchley, the daughter of Alan Shepard, who was the first American in space, and 4 paying passengers. Now, it launched from Blue Origin's West Texas site, a 10-minute, 13-second journey more than 66 miles above Earth, a soft touchdown back in the desert, and of course, Jeff Bezos on site to greet the newly minted astronauts. David, I mean, I've been talking about it all year. It's been a gangbusters year for spaceflight, for human spaceflight. And we've seen, I think we're closing in. We won't quite hit that number, but close-ish to about 36 private citizens that have made the journey to space this year. Enough that the FAA is now doing away with its commercial astronaut wing program.
Well, it's going to get to the point where we don't even note it anymore. We're probably getting pretty close, where it's just going to be, oh yeah, this weekend another 3-4 people, this whatever it is during the course of a week, right? I mean, that's where we're headed very quickly.
Yes, that is where we're potentially headed, and certainly with Blue Origin, I mean, the company is now expecting to do at least 6 more of these suborbital missions in 2022, and then of course by the end of next year, if all goes according to plan, Virgin Galactic enters the fray as well. All right, well, for more, let's bring in one of those astronauts that was on this weekend's flight, Voyager Space Holdings Chairman and CEO Dylan Taylor, who is also the founder of nonprofit Space for Humanity. Dylan, great to have you back on the show. Congrats on becoming an astronaut. I have to ask you about the flight. What was the best part? What was this experience like?
Well, good to see you, Morgan. Life-changing, and I'm not exaggerating when I say that. The ride-up is unbelievable. You know, you're riding a rocket, literally. But when you unstrap and you can go to the window and see the Earth from space, I know it's been said before by other people who've been there, but it's truly miraculous to see the Earth from space. It really is.
What was the training like?
The training was spectacular. We really came together as a crew, brothers and sisters for life. You know, you're going through something very, very unique and literally putting your life on the line. But the training was really, really fantastic, to the point where on game day, when we were loading in the rocket, I don't think any of us had the nerves that you would expect.
Now, you were one of the 4 folks on this mission that paid for your seat. How much did you pay? And how did this actual mission come together? When did you find out you were going to be on board?
Right. Well, I found out about maybe 3 months ago I was going to fly on Blue in the future. And then I found out maybe a month after that I was going to fly this year, which I was very, very happy to hear. Unfortunately, I can't disclose, Morgan, what I paid. I can say it's worth it. I can say that definitively. The other thing I just want to plug, if I can, is, you know, one of the call to actions I did for other commercial astronauts is buy one, give one. So I'm donating the equivalent of my ticket price to worthy causes here on Earth. And I think that's important, because part of the narrative around this is, you know, space is a selfish endeavor and it has nothing to do with the problems we have here on Earth. And I disagree with that. I think space is part of how we address problems here on Earth.
Yeah, and we're just having this discussion right before we brought you in, and it's the fact that it has been a record year for human spaceflight, both on the government side, but also on the commercial side as well. It speaks to this trajectory we hear about from so many folks that have, like Jeff Bezos or like a Sir Richard Branson, that have invested in commercial space. This idea that it's going to be like the airline industry, where it starts with deep-pocketed folks that are willing to do a ride such as this, and then as it grows in scale and it grows in acceptability and becomes more mainstream, those prices come down and it becomes more commonplace. How long do you think that process takes?
I think we're going to be there sooner than we expect. I agree with David. I think this is going to be very commonplace here very soon. And for those of us who have been in the industry for a long time, and those of us at the Commercial Spaceflight Federation, this is what we've dreamed of, right? And so the ability to get people up there to have this unique experience, and then hopefully come back and really work on some of the issues we have here on Earth, I think is the promise of space. It is a tool for transformation. I've always believed that, and now I know that.
Yeah, and of course you have been in this industry a long time, and you do have this company that you have been building as well that is eventually, I think, expected to go public via an IPO. We're keeping an eye out for a filing there. You're not focused on rockets. Your vision and your business strategy really lies with establishing and growing economic activity in space. So now that you have just made this trip, how does that impact your business thesis?
Well, it confirms it, right? So we were fortunate. We were one of the 3 winners that NASA just awarded the space station replacement contract to. And so I believe we need more destinations in space, right? And suborbital is a path to orbital, orbital is a path to lunar, lunar is a path to Mars and beyond. And so we're on a roadmap here to really open up the high frontier.
Dylan, thanks so much for joining us. Congrats on becoming an astronaut and on the trip. We appreciate your insights.
All right, we got a big show coming up in the next hour for you. Don't miss it. Adobe CEO Shantanu Narayan on Tech Check. He'll be discussing the company's new products. By the way, the stock, Adobe, is, after what's been an incredible 5-year run already, still up more than 30% year to date. It all starts about 10 minutes from now, so don't go anywhere.
Welcome back to Squawk on the Street. I'm Seema Modi. Stocks are lower this morning, led by the travel and leisure sector, following Prime Minister Boris Johnson's warning to the UK citizens on what he calls a tidal wave of Omicron infections. He's setting a new booster target for citizens there. Cruise lines, which do tend to be the most reactive to COVID headlines, are firmly in negative territory. Royal Caribbean, Carnival Cruise Line, and Norwegian down just about 5%. We're also looking at hotel operators, booking companies lagging, including names like Expedia, Marriott down about 3%, Hilton down 2.3%. Now, later today, we will get an update from the TSA about the agency's plans for an expected surge in travel during the holidays. There's more ahead. Stay with us.
Welcome back to Squawk on the Street. Our Eamon Javers is looking at one cybersecurity flaw that an expert called, quote, the scariest vulnerability he has seen in 20 years and maybe ever. Eamon, what are we talking about here?
Well, Morgan, the expert who told me that is cybersecurity researcher Dmitry Alperovich. Talking over the weekend, he said, this is such a big problem because the software involved, which is called Log4j, is ubiquitous. It's a popular Java open source library for logging data, and it's embedded in thousands of products. Alperovich says it's used in everything from Apple's iCloud to the Mars rover, and there's no guarantee that software publishers will be able to patch the problem before hackers take advantage of it. Now, the software was initially designed to take data from an app and store it elsewhere, but a feature that was added back in 2013 allowed users to send data that would be interpreted as a URL so the program could then execute code. But by the same token, that feature also allows attackers to send malware. And since its discovery last week, it's already being exploited by bad guys like hacker crypto miners and malicious nation states. Now, the U.S. Cybersecurity and Infrastructure Security Agency posted an alert about the flaw on Saturday, warning that the vulnerability poses a severe risk and urging cooperation between the government and the private sector. Now, the challenge here is that this software is embedded in so many products. It means just about every company will be impacted by this new flaw, which is just coming to light. And since there are so many vendors involved, it's not clear when all these patches will be made. And that means the bad guys will have an open door for a long time. Some experts think we'll be dealing with the fallout from this for months, if not years. Morgan, back over to you.
That certainly sounds pretty scary. I mean, Eamon, you covered this so closely, and one of the conversations that's been increasingly coming up in the midst of all of these widespread cybersecurity issues we've seen over the past year plus is this idea of supply chain vulnerabilities within the software as well. Is that what we're talking about when it comes to this vulnerability as well?
Yeah, I mean, this is supply chain vulnerability on steroids, Morgan. I mean, they initially found this last week in the video game Minecraft, which I can tell you my kids spend a lot of time playing. And apparently people figured out that this vulnerability existed there. And then there was this sort of moment of awakening where they realized, hey, wait a second. This is in just about everything. I mean, it's thousands of different programs out there that use this piece of software, which is open source, which means anybody can kind of lift it and plop it into their program. That's what people have been doing and not knowing that it had this flaw. And now there's this epic race going on between the hackers and the patchers. As the patchers try to send out software updates, the hackers are trying to figure out where all this software is and exploit it as quickly as they can. That process might go on for months, and it might mean that a lot of companies have a lot of back doors open that they didn't know they had.
Right. Okay. So that Eamon could conceivably result in a lot of data being stolen and/or a lot of other stuff, I guess, if you don't get to your back door and close it.
Yeah. And the problem for companies, David, is that it's not that you can do it yourself. I mean, Dmitry Alperovich told me over the weekend, one of the big problems here is that you have to wait for your vendors to do it. So you might have hundreds of vendors who operate software that has this flaw in it, and you now have to wait, if you're the CEO of a large company, for all of those vendors to go ahead and patch. And some of them are taking it more seriously, some of them are taking it less seriously, and some of them are moving too slow, in Dmitry's view, to get this done. There was a huge rush over the weekend for a lot of people to update and patch, but it's not clear when that process will be finished. And for a lot of CEOs, you know, this could be sort of a panicky waiting period while they wait and see who's going to patch and when.
All right. We'll be watching it. We know you will be watching it closely, Eamon. Thank you.
Thanks, Dave.
Let's give you a quick check on Tesla before we close out the hour. Of course, Elon Musk was named Time's Person of the Year. The stock, though, not reacting that positively, Morgan, to that honor, I guess you have to say it is at this point. And remember, you've got a 52-week high here of $1,243. So still a strong year, but well off the highs.
Well off the highs. And of course, Time Person of the Year, perhaps not surprisingly. I mean, given all the milestones we've seen with Tesla, but also the milestones with SpaceX as well. We were just talking about human spaceflight earlier. I mean, SpaceX has been on the forefront where that entire commercial space discussion has been, and Time has been covering it very closely with the Inspiration 4 mission we saw back in September as well.
Yeah, I don't think there's any debate that he is right now the iconic person in the business world. I think you could argue, given it's not just Tesla, it's also space as well. That's going to do it for us on Squawk on the Street. It's time now for Tech Check.
Happy Monday. Welcome to Tech Check. I'm John Fort with Julia Borston. Carl and Deirdre are off today. Apple within a stone's throw of $3 trillion. Is the world's biggest market cap company still cheap at this valuation? Plus, Cowen naming Amazon its top mega cap pick for 2022. The analyst behind that call joins us in just a few minutes. And then exclusive interviews with the CEOs of ServiceNow, EY, and Adobe. Julia.
And let's start off with Apple, John. A relentless move higher. It's in the green again today and up 21% in a month, now approaching a $3 trillion market cap. So what would the magic number be? $182.86 a share. Analysts are racing to keep up. Wedbush and Morgan Stanley upped their price targets just last week. Today, it's JP Morgan calling the stock a top pick for 2022 and hiking its price target to a new street high of $210. arguing Apple is well positioned to outperform thanks to a stronger than expected iPhone product cycle. But is the stock cheap or expensive? Two measures of evaluation here. Take a look at Apple's trailing 12 months PE ratio and its enterprise value to sales ratio. Both are certainly creeping higher than historical levels. Our Josh Lipton with us now from the NASDAQ. Now that 20% move in the last month, analysts now scrambling. What's the consensus on how much more room there could be for this stock to run?
Well, it's interesting. If you look at that recent move, Julian, certainly a lot of people have piled in. You know, some analysts are going to say in this uncertain environment, Apple has simply become a holding for people that, as they note, as one analyst put it, just makes some investors feel like they can sleep more comfortably at night. The big company, strong balance sheet, a product portfolio that continues to gain share. And of course, they'll note that higher margin, steady growth services business that so far, at least, hasn't been stung by those regulatory risks, guys.
Josh, wasn't there supposed to be a law of large numbers? Who's going to get punished for breaking this law? I mean, I thought Apple broke it when it hit $1 trillion, and now it's just flouting the law. It's just thumbing its nose. But seriously, I mean, it was just a couple months ago, I think it was, that we were talking about Microsoft passing Apple in market cap. Now they're about, what, 400 billion away. Is that right? My goodness. I mean, something different happening with Apple here in these mega caps.
Well, it's interesting. I mean, $3 trillion is a big number, and what it gives investors the chance to kind of take stock and think about where you go from here. Now, for our audience, John, for traders and investors in the near to intermediate term, what they have to decide is how well you think that iPhone 13 cycle is going to really perform. Are the skeptics right who say, listen, the 12 was very strong, but that pulled forward demand, and the 13 is going to disappoint? Or are the bulls right that, listen, Apple's going to work through these supply chain issues, and the demand is going to be there, given just how many millions and millions of people around the world are selling these older devices? And then, of course, you have to think about longer term, what are the big mega tech trends, and is Apple well positioned to capitalize on them?
Well, yeah, it's interesting as we see all these analysts jump on the bull case here. I want to ask you, Josh, about the skeptic case, because, you know, we do have so much uncertainty. Obviously, there are these supply chain constraints. There's so much focus on what's going to happen with this next iPhone cycle. But what is the bear case for Apple? What are the factors that could keep this stock from hitting that $3 trillion mark?
In the near term, listen, it is about that iPhone demand. It's about their flagship product. We have seen a lot of headlines dropping about that. Different reporters claiming to talk to different suppliers. Of course, on top of that, if you're an investor, you have to wade through different analyst notes. Those analysts are doing their own checks as well. It's very hard to get a read on that. Sometimes you'll look at data points too. Broadcom obviously recently reported, knocked it out of the park. They have their own wireless segment. Broadcom obviously supplies chips for Apple. That was a very strong report. I know there are some analysts actually on Tech Check, I remember saying they thought, given Broadcom's report, that it puts that issue they thought to bed. But again, we'll see what Apple actually reports soon.
Yeah, well, those shares pretty much flat today as we await and watch it slowly inching towards that $3 trillion mark. Thanks so much, Josh. Now shifting from Apple to Amazon, Cowen naming Amazon as its top mega cap pick heading into 2022, upping its price target to $4,500, arguing the nearly $2 trillion company stock hasn't even fully priced in outperformance for AWS and advertising. Joining us now, the analyst behind that call, Cowen's John Blackledge. John, thanks for joining us today. Talk to me about what you're seeing in terms of AWS and advertising. What should investors be thinking about that they're not?
Yeah, both accelerated this year, and it really wasn't reflected in the stock. I mean, the advertising business was up, I think, 70% this year, and AWS accelerated. But our call is actually that the e-commerce business is going to start to accelerate in 2Q22, and you're going to have rising margins. Those two things combined, we think, will drive shares higher. We slightly raised our back half 22 numbers. And long-term numbers, like you said, price target to 4,500 a share, a little over 30% upside from here. We're 1%, 6%, and 10% above consensus 22 revenue, op income, and EPS. And with Amazon shares trading at 18 times EBITDA, it's like slightly below the midpoint of its historical range. So we think with the improving fundamentals, and AWS and advertising will be robust again next year, we could get multiple expansion, and that's why Amazon's our top mega cap pick.
Yeah, and coming up against some easier comps, but I have to ask about that outage last week. You know, Oracle, when they reported their earnings, took a lot of digs at Amazon for being unreliable. Does that kind of thing have any long-term impact?
I don't think so. I mean, we've seen incredible strength at AWS, and we've seen incredible investment both at AWS and data centers, data center growth, and also obviously in fulfillment growth. And that's one of the things that we think is going to be a driver for 22 is the investment in the fulfillment infrastructure. They've spent over $60 billion the last 2 years. The prior 5 years, they spent cumulatively about $40 billion. They've more than doubled the size of the fulfillment network. And while we're going to see comps on the e-commerce side ease as we head into get through 22, you're also going to have the Prime One Day and Same Day driving higher product conversion. So you have two things that are going to be driving the acceleration in the e-commerce business.
John, speaking of fulfillment, this tragedy that happened on Friday when an Amazon warehouse in Edwardsville, Illinois collapsed, at least 6 dead there. Amazon has said that they want to be the world's best place to work, and there are going to be a lot of questions about the conditions that were in place as this tragedy unfolded. Should we expect that Amazon is going to spend perhaps even a lot more to make sure that something like this doesn't happen again, or is there any overhang, things like that investors should also be concerned about?
Yeah, John. I mean, like I just mentioned, they spent over $60 billion the last couple of years, and it was horrific events across many states. And so yeah, I'm sure they will double back and try to ensure that the safety for their employees and spend whatever it will take to ensure that their employees are safe, going to work every day.
Okay, so from an investor standpoint, your feeling is that the sentiment on the business overall, including cloud, is going to be such that if there is even more of a spend on the capital side for that kind of thing, it won't spook investors?
Well, they've just spent so much. It's accelerated so much the last couple of years that we think it'll start to that growth will start to, kind of ease, and hence we're going to start to see margins expand. We think in the back half of the year. They're going to obviously continue to invest heavily in both cloud and the e-commerce business and other areas of the company. But it should start to ease. I mean, it's been historic investment the last couple of years.
Speaking of margins, how essential is it, in your view, that Amazon increase the price of Amazon Prime? How likely do you think that is, and what happens in terms of consumer reaction and obviously sort of the play into margins?
Yeah, thanks for that question. I think that's a good one. That's something that we called out that we may get. The last time they raised the cost of Prime was 2018. Prior to that, it was 2014. So maybe we're going to go on this, kind of 4-year cadence. And so what's happened since 2018? We've way more than doubled the fulfillment network. They've introduced One Day. They're bolstering their same-day capabilities, which is really where this whole delivery speed thing is going. And then also on Prime Video, they've invested heavily in original feature films, original episodic content, and then they got the NFL rights, the Thursday night football rights starting next year. So there's a lot of, I think the way the company thinks about it is like, what have we added to increase price? And with over 200 million Prime members globally, and the prices vary by the country, but 200 million people, you raise it $10, $20 the annual number, you're at $2 or $4 billion of incremental revenue, high margin revenue. And we think, given all the things that they've added since 2018, it would be, it'd probably be fine. And the consumer would be, Prime sub would be fine with it.
Well, that will be an interesting one to watch. John, thanks so much for joining us to talk about your very high price target for Amazon.
Thank you.
Meanwhile, the CEOs of ServiceNow, EY, and Adobe are coming up. Tech Check is just getting started.
We mentioned it moments ago, tornadoes causing massive destruction across the Midwest, multiple communities and businesses devastated, including an Amazon warehouse where 6 people died after a building collapsed. NBC's Morgan Chesky is live in Edwardsville, Illinois. Morgan?
John, good morning. And I can tell you that daybreak here brings a steady stream of construction crews trying to remove the debris from what's left of that warehouse that an EF3 tornado just laid absolute waste to on Friday. It struck about 8:30 p.m. Amazon tells us that they now know there were 46 people inside that massive building, about the size of a football field, when this tornado struck. Over the weekend, the death toll rose to 6. The names and ages of those individuals were released late yesterday. Crews were able to arrive on this scene within just a few minutes after the tornado struck, because this really was the spot, John, that the tornado unleashed its fury. We're in the Edwardsville area. It was largely spared. This facility was not. They were able to get the overwhelming majority of those employees out safely through the rubble. However, that came at the loss of 6 lives when the walls and the roof partially caved in as a result of those incredibly powerful winds. Amazon, meanwhile, has donated $1 million to a local Edwardsville charity to help anyone impacted by this storm. I can tell you that standing here today, one of the most telling images has been tow trucks leaving the scene, and they have cars that were parked around this building that look as if they had been placed inside of a compactor, completely unrecognizable as to the make or model of the vehicle. And even though this tornado hit in just a few seconds, it gives you real pause knowing how much power it brought through this area. We confirmed with the National Weather Service that this twister touched down barely a quarter mile away. We know that sirens went off around 8 o'clock inside the building. It was at that point that the employees kind of split up into 2 groups to seek shelter. There was a designated shelter area inside the warehouse. We don't know how many were there, but we do know that whoever was on the southern edge of this building took the brunt of this storm. That's left so many people in this community struggling to move on from this loss of life. John?
Yeah, Morgan, I'll pick it up from here. Such a horrifying story. I have to ask you about this question about the cell phone ban. I've seen the headlines saying that Amazon's, preventing employees from having cell phones while they are working could have maybe prevented people from getting the information that they needed to get to safety sooner. Tell us what you've learned about that.
I had a chance to speak with an Amazon spokesman just a few minutes ago. I asked him that direct question point blank. He tells me that at this facility and at every facility that he's aware of, that ban is not in effect. They did have, again, 46 people inside. He says that each one of those individuals were able to have their cell phone on their person and use it accordingly. In fact, I spoke to the mother of a young man whose life was lost, Clayton Cope. He was a 29-year-old Navy vet who had been working here about 1 year. His mom told me that right about the time the tornado sirens started going off, she called her son here at work. He picked up the phone. They had a brief conversation. She told him, hey, make sure you seek shelter, and I love you. That was the last conversation they had. Just going to show, though, that employees inside were reachable on their phones throughout this ordeal. We'll send it back to you.
Morgan, thank you. Important reporting detail from the sign of a tragedy. Now, ServiceNow and EY announcing a new strategic partnership, an agreement the companies say will double the value of their existing relationship to $1 billion by 2025. Joining us now, ServiceNow CEO Bill McDermott and EY CEO Carmine DeCibio. Gentlemen, good morning. Bill, go-to-market is so important right now. Partnerships so important for what's happening in software. What is this one in particular going to do for back office workflows?
Thank you very much, John, and good morning and happy holidays to you. This is so exciting. Carmine and EY run a great business with 312,000 employees. So just think about the bandwidth of this partnership. And we committed to an incremental $1 billion partnership over the next 3 years in terms of value creation for shareholders. And specifically, if you think about tax and finance functions today, they're way too complex. Tax reform, the explosion of data, And the whole hybrid work movement has made things very difficult on executives who are saying, hey, I've got to shift from a transactional work life to a data-driven and analytics work life over the next 3 years. So EY and ServiceNow are offering customers tax, payroll, outsourcing, wealth management, procurement, and supplier self-service solutions that make that possible. And John, I think this is really one of the super exciting things that'll ever happen in the finance department around the concept of digital transformation in companies at mass scale, headquarters and all of their satellite offices alike.
Well, people who don't work in the finance department might have a hard time wrapping their heads around exciting things happening in the finance department. So let's talk some more about that. Carmine, how has the pandemic and the shift in workplace models complicated some of those processes in finance and tax services when you're trying to determine where work is getting done, things like that? And how will this work with ServiceNow give your clients more tools?
Thanks, John. It's great to be here, and it's great to be here with Bill. Look, we are so excited about this partnership. And through the pandemic, what we've learned and what our clients have learned, that it's really all about being digital. And as I mentioned before, maybe on your program, when we first started before the pandemic, only 25% of our clients actually had a digitized supply chain. And that obviously has been changing. It has to change more and more. And it's no different in tax and finance. As Bill mentioned, right now, everything around tax is around data and collecting data and making sure that you're able to put the data together to really give that data in some kind of form to a government. So our tax business is really becoming much more of a platform business. And with that, we need the tools and we need the workflow tools that ServiceNow has. And right now, John, there is a tremendous amount of conversations going on with corporates, with all our clients around how do they really digitize their tax function and their finance function. And frankly, we have a multi-billion-dollar pipeline of companies that want to outsource their tax function to companies like EY, knowing that we have the workflow and the investment in technology, and this is part of that. It's so great to team with Bill and with ServiceNow because the tools that we're able to produce are going to make things much easier for our clients. And Bill mentioned it before, the scale here is tremendous. The amount of scale that we can produce to our clients around the world is really, really important. And we're very excited to be able to do this with ServiceNow. The other part of this, John, that we have is we're utilizing our neurodiverse centers. And this is something that Bill's very familiar with, where we actually hire people who are neurodiverse, who some of them have autism or Asperger's, but they are incredibly valuable to us. And they have incredible skills in areas like this where they can operate and operate around the world. We have 12 centers around the world, and we're growing those as well.
Yeah, interesting approach there. Now, Bill, tell us a little bit about this this real push to hire people with neurodiversity. What does that mean, and what is it going to mean for your business and your employee base?
Well, Carmine has just done an unbelievable job in this category, and that's one of the reasons why we're so honored to establish the ServiceNow Neurodiversity Delivery Center with EY. So we're going to partner and we're going to drive our customer outcome business along with EY's ServiceNow practice to essentially take leaders and employees around the world into a completely different movement. Right now, the creator movement, where people can build applications on a low or no code platform like ServiceNow to innovate literally in days and weeks instead of years. So we think that the neurodiversity movement that we're on together can bring in lots and lots of new jobs. And this is really about not just doing well, because our companies are doing well, but we're looking at digital transformation together. Carmine, myself, the great leaders at EY and ServiceNow, we're saying we need to take doing well into doing good. Digital transformation will easily be the biggest opportunity of our lifetimes. And now we're going to create literally thousands of jobs all over the world for uninitiated workers in the economy that bring super special skills. And bottom line, there's no ceiling to anyone's dreams out there. With EY and ServiceNow, we warmly welcome you. Give us a call. We want to get you to work right away.
Bill, give us a step back now, because a lot of us remember ServiceNow from a few years back, even before you got there, doing basic requests inside of an enterprise, make sure things get done. But you've been here on Tech Check talking to us about indoor mapping and being able to schedule spaces inside the enterprise. Now we're talking about finance and tax functions just within the overall SaaS and enterprise software ecosystem. What is it that ServiceNow is addressing? There's a lot.
John, it's a great read. Fred Luddy invented this company in 2004, and he invented a platform. It just so happened that platform was first adopted by IT professionals because they saw the immediate magic in all the things it could do to automate work, make work flow, and really improve people's ability to collaborate across the enterprise, keep things secure, drive service management to the business, manage your assets and your operations. That was fantastic. But that same platform also serves the employee experience, where you have one portal, all your services are there. You can recruit, hire, onboard, train, and manage all the cases for your employees. And then it came into customer service, where you could predictively use machine learning and AI to manage the customer relationship. And now, in a post-pandemic or even an endemic world, you're seeing the experience has to be brought to the customer. They're no longer coming to you the way they once did. And all of this now is manifesting itself into a world where people want to create their own innovation, and they want to do it today on the Now platform. That is a sensation. So think of us as the enterprise platform for workflow, and any problem a business or even a government faces can easily be workflowed on the Now platform to truly innovate, but do it, John, at a speed and a form factor that's never been achieved before in the enterprise.
Okay.
So yes, we have moved in a perimeter that has always been there for ServiceNow. It's just that the vision, the bandwidth, the partnerships like the one we have with Carmine and EY have expanded at mass scale.
Yeah, it's a big vision. Just want to put that in context. Bill, Carmine, thank you.
Thanks, John.
Thank you very much, John.
After the break, we sit down with the CEO of Adobe as that company expands its cloud offering, plus a reshuffling of the NASDAQ 100, how the changes could impact investors. There's more Tech Check after this. Welcome back to Tech Check. I'm Julia Borston with John Fort. Stocks moving lower now. The Dow down more than 300 points. The Nasdaq lower by more than 1%. FANG lower. The ARK funds lower. Tesla, Chinese tech stocks, Nvidia hit particularly hard. And even Apple is lower. We are continuing to watch those shares as it nears that $3 trillion market cap. Now it's down nearly 1%. But first, let's get a news update with Rahel Solomon. Rahel?
Hi, Julia. Good morning. And here's what's happening at this hour. Pfizer is putting some of its COVID vaccine profits into an acquisition. It's buying Arena Pharmaceuticals for $6.7 billion. That's more than double Arena's market cap on Friday. Arena is developing a number of drugs, including one to treat ulcerative colitis and Crohn's disease. The Supreme Court allowing a lawsuit to continue against Johnson & Johnson over its talc products. Mississippi is suing the company for failing to warn consumers that its talc products increase the risk of developing ovarian cancer. Harley-Davidson's electric motorcycle division is going public. It's combining with a SPAC to become the first publicly traded EV motorcycle company. Harley shares are up more than 11% following the news. And stock buybacks at a new all-time high in the third quarter, surpassing $234 billion. That's according to S&P Dow Jones indices. The group expects another record this quarter. This morning, Bristol-Myers announced a new $15 billion stock buyback plan and a dividend increase. You're now up to date. John, I'll send it back to you.
Rahel, thanks. Now, big product news from Adobe today, Creative Cloud Express, the software giant answering smaller rivals like Canva with a lightweight web-based creative tool. It allows users to make things quickly. Creative Cloud Express will leverage existing Adobe flagship applications and frameworks like Photoshop, Premiere, and Acrobat. And joining us for a Tech Check exclusive from Adobe headquarters in San Jose, CEO Shantanu Narayan. Shantanu, good morning. So explain, if you will, where Creative Cloud Express fits into the larger model, kind of pricing and the degree to which you expect it will draw some people into the broader Creative Cloud.
Well, John, it's always great to be back on your show, especially at a momentous occasion like this for Adobe, when we're announcing, as you mentioned, this new unified web and mobile offering called Creative Cloud Express. And what we're really trying to do is to enable everybody who is a creator to really participate in the creative economy. And we think, as we have hundreds of millions of people who are using our product, that every one of them, as they want to start the creative process, whether you're a creative professional, whether you're a student, whether you're a communicator, we think this product is really meant for every single person. So for the existing Creative Cloud subscriber, to your question, it's going to be a value-added feature that allows you content first and understanding intent to be able to create. But for the billions of people who have never been able to tell their story in a unified, seamless way, this is a best on-ramp that's available. It allows you to leverage all the content that we have. It leverages Adobe Sensei. It's available in a pervasive way across the web and mobile. So we're really excited as the holiday season emerges to see what people are going to do with this product.
Tell me how this evolved. You've had Express products like Photoshop Express for years and years, and you had Spark products like Spark Video, Spark Post. I recognize some elements from both of those ideas coming together here. To what degree does this kind of cancel out what's happened before, and to what degree is there a new vision or direction?
John, I think this actually leverages all the incredible decades-long work that we have done. To your point, first we had actually the Elements product line, if you remember.
Yeah.
Then as mobile emerged, we introduced the Express line, we introduced Spark. But really over the last couple of years, as Scott Belsky, who's our chief product officer, has been reimagining the creative process, this really unifies and brings together all of the different streams that we had. We had Photoshop Express that allowed you to do things with imaging. We've had Acrobat on the web that allows you to do things as people want to create PDFs or share PDFs. And really, the brilliance, I think, of this offering is bringing it all together in a unified offering, truly understanding how content-first authoring can revolutionize the creative process, understanding strategic intent. because when somebody is looking to do something on the web, we can immediately take them into an on-ramp with a template, beautiful content, high fidelity, precision. And so I think it's actually leveraging it, and certainly underlying all of this and the magic behind the scenes is Adobe Sensei. And what we've been able to do is actually take file formats like Photoshop or Illustrator or InDesign and make them, really sing on the web as the web browsers, whether Chrome or Edge, have continued to advance. So it's the culmination of many years of effort at one level, and it's the beginning of a new journey at another level.
Now, can you explain why you're not going to see cannibalization from this? What kind of work you've done to make sure that the people who are paying full freight for Creative Cloud aren't going to sort of downgrade to this?
Well, we really believe that, we've always had a massively significant communicator base. If you think about the people today who are using products like Lightroom or using Acrobat on the web, the reality is we're probably the world's largest provider of creative and document tools for, the communicator as well as the consumer. And so what we also have is this incredible data-driven operating model that allows us to really understand customer segments and to understand what is the best offering for them. A good example of that is what we do with PDF, which is, we have a one-time offering, we have premium offerings, we have freemium offerings. And so I think it's the extensive nature of our product line and the rigor that we have behind it financially that gives us a lot of confidence that this is actually going to be accretive and make creativity available to all.
And finally, Shantanu, one for you. Outside of Creative Cloud, you've also got the broader digital experience business, and you've got the Adobe Digital Index that's been looking at shopping overall and holiday shopping. What sort of signal are you getting, particularly in this unique 2021 Q4, about the blending of physical and digital retail and clarity, frankly, in this inflationary environment?
John, you're right in that we have our pulse on what's happening with digital better than any other company. And I think there are a couple of trends that continue, namely online commerce is up and to the right. And so I think that's a trend that's going to continue for decades. What we are seeing is maybe some of the spikes that existed in the past, like Black Friday or Cyber Monday, those tend to get smoothened out a bit as, new merchants that are coming online are trying to either beat the holiday rush and provide promotions a little bit earlier. So that's a trend that we clearly see. The second trend I would say that we're seeing is B2B companies. Every company that's a B2B company is also saying, how do I participate directly online? Even if I have a distribution channel or a two-tier channel, how do I make sure that I get my brand? And so they're all dipping their toe in the water and making sure that they engage in online commerce. And I would say the third trend that you're seeing is new payment methods. As people are trying both promotions, the buy now, pay later, or the order online and pick it up in store, I think you're seeing these hybrid payment as well as customer opportunities that are also emerging in the online space. But we continue to believe that the holiday season, you're going to see more and more companies engaged with their customers primarily online.
All right, and we tied the creative product that draws people into the commerce process in the back office that we were just talking about with Bill McDermott and ServiceNow and EY and Carmine as well. Shantanu, thank you.
Thanks for having me, John.
The S&P and NASDAQ are lower today, but both are coming off their best week since February. The S&P set a record close Friday, but investors and portfolio managers with heavy single stock exposure might feel differently. Take a look at this chart. S&P is up 25% this year. If you're an investor in PayPal, Zoom, Peloton, or Snap, it has been an ugly fall. More tech techs back after this break.